When we were having the discussion on the finance bill provisions, looking at the complexity of the sections concerned, and you would have seen that in the entire morning session on charitable trust, virtual digital asset, and looking at the discussions among us, Chaitanya and SRS told me, you can't handle this. You wait for a post-lunch session. We will give you a little easier topic. They said we are borrowing the philosophy from the FMC speech. Yoga Kshema. We are looking at your welfare. After going through all of this in the morning session, they also told me also, they said we follow Rahul Dravid's principle of what everybody will get a chance. So will you get a chance in the afternoon. After going through all of this in the morning, looking at the complexity involved, I was wondering whether the FM knows the law at all. Doubts. If the FM knew the law and she knew it correctly, then there is no need of an exposition of that law. There's no need of a commentary for that law. She knew law very clearly, what she's expressed very clear. Where's the question of a commentary about that law? Because the law is very clear. Nothing else is to be stated beyond that. Assessors who read the law or who read the law, they also don't understand that law. Because if they knew the law or they understood the law very well, there is no need for an assessing officer examining his contention. There's no need. The assessing officer who read the law, he also doesn't understand the law. Because if he understood the law, there is no question of an appeal at all. The lawyer who argued the appeal, he doesn't understand the law. He doesn't know the law. Because if he knew the law, there are no need for an opposite counsel. Somebody else, he doesn't know the law, therefore we want an opposite counsel. The judge who had heard both of them, he also doesn't know the law. Because if he knew the law, there is no need for an appeal at all. Why have they provided for an appeal? Huh? So who knows the law ultimately? Supreme Court. Because ultimately there's no appeal beyond that. But in my opinion, even Supreme Court doesn't know the law. If they knew the law, there is no need to call three of us to explain what Supreme Court has decided. Only one was sufficient. Why three of us are required? So ultimately, the sum and substance is nobody knows the law. With this background, we will now discuss. We will discuss certain mundane topics. Section 14A. A very interesting language, very interesting concepts. Therefore, you have to understand what they're trying to convey. The question is, feel is one. I get the feel of the section as one. But the other is it a very correct legal understanding of the subject is extremely important also. I have to understand, therefore, the law, not just as an academician. I have to understand the law as a taxpayer. I have to understand the law as a lawyer also, because I have to ultimately litigate tomorrow. Academician, taxpayer for planning, and a lawyer for litigation purposes. Therefore, it's important for us to understand the law in all its facets. Therefore, the feel of it is fine. You can know, this is the intent of the subject. Fine, absolutely fine. But beyond that, therefore, we need to plan around it, possibly find ways and means. Are there any avenues available for us to take some benefit out of the provisions of law? Or if called upon tomorrow, are we able to defend it in a manner beneficial to the assessors concerned? Therefore, the various dimensions of the law are required to be understood by us. And therefore, in that background, we will discuss some provisions of law and the language that is employed. And most of the morning session are also that, to say that, yeah, number of questions, what happens in this, what happens to a VDA, what happens to a violation. Most of it, therefore, we are able to get the feel of the law. But we are able to ask questions for the reason that the law is possibly not addressing a particular situation. Which situation, therefore, can it be exploited by us tomorrow, either as a planning strategy or as a defense strategy? Therefore, it becomes very important for us to know the law. 14A is a very interesting example. We have had 14A, we have had litigations all along, largely related to dividends. Dividend not taxable. But now they're trying to change the law today. For incomes that are not be necessarily exempt now because we are looking at dividends largely, big way. They're not taxable today. So you can find out 10(1), 10(2)(a), 1046, government bonds which are exempt. There are certain instances available. But nevertheless, to address the expenditure in relation to those incomes concerned, law has been amended. Basic philosophy is that expenditure in relation to that exempt income should not be allowed to you as a deduction. That's the basic philosophy. Going by earlier Supreme Court decision in Rajendra Prasad Modi's case, they said that when you want to allow an expenditure under section 37, what does the law say? It has to be an expenditure wholly and exclusively incurred for the purpose of business. That's the only test. The presence of an income on the credit of the profit loss account is not required. The only test is look at the debit and say, is it an expenditure wholly and exclusively for the purpose of business? The answer is yes. Then don't have to demonstrate the presence of an income on the credit of the profit loss account. It will be allowed even otherwise. They were referring to that Maharashtra, Rajasthan state warehousing 242 ATR. I will not go into all of those controversies. The question therefore is now the law is trying to say, look here, if you are having an income which is exempt and you are having an associated expenditure, now I'm not wanting to apply the old principle to say, look at the character of expenses. No, I also want you to draw a nexus to the income. And if the income is exempt, I want the expenditure to be related to that income. It cannot go and eat away your other incomes beyond the exempted incomes concerned. Therefore, they brought in 14A. But then business and the way the commercial world works, you can't get all solutions immediately. So what people began saying, look here, my expenditure is 100. My income is only 14 rupees. So what should I do? The expenditure for that income is only 14 rupees. 14 rupees is the income, 100 rupees is the expenditure. How much should I now allow? The whole of 100 or limited to, the disallowance should be whole of 100 or limited to 14. Court said no, limited to 14 rupees. They took the logic forward to say 100 rupees expenditure, no income earned. What should be the disallowance? No disallowance. So therefore they're saying, although the expenditure was referable to an income which was exempt, the maximum disallowance could have been limited to the incomes earned. It can't go beyond that. So this was contrary to what the legislature believed to be the spirit of 14A. They said, no. The linkage is not required. If the expenditure is to an income which is exempt, or when you earn tomorrow will be exempt, or it is more than the exempt incomes, we are not concerned with that. We want the entirety of the expenditure to be disallowed. Court didn't come to the rescue of the department. Therefore, they are making an amendment now. Therefore, they are saying, notwithstanding anything contained in any of the provisions of the Act. So 14A, I want to make it very powerful. Notwithstanding anything contained. Now, when you start reading it, therefore, it overrides all of the provisions of the law. Interesting question is that this is substituting the opening words of 14A for the purpose of computing the income under this chapter. The opening word is currently. They're saying, notwithstanding anything contained in any of the provisions of the Act for the purpose of computing income. 14A itself came into the statute book with effect from 1/4/1962. And therefore, when reading now, notwithstanding anything to the contrary in any of the provisions of the Act, it's substituting the opening words. So technically, therefore, when substituting an opening word, will the new word apply from retrospective effect from 1/4/1962, or something else could be an answer? Because the whole of 14A is to be applicable from 1/4/1962. So even the substituted words should technically be applicable from 1/4/1962. That way to be the proposition, we are now facing a serious issue to say that tomorrow, pending assessments, pending appeals, whatever is happening, this law will override everything else that is to the contrary. And the law is now trying to tell you, I want expenditure referable to exempt incomes. Now, whether you have earned it or not, or you earn tomorrow, if it has a character of exempt income tomorrow, the expenditure should not be allowed. Therefore, the question therefore is that if this were to be the substituted provision effective from 1/4/1962, this is the way to read the law to say the new section also will be applicable from 1/4/1962. Generally, yes, because you are substituting a provision of law and one word or a couple of words are substituted, unless the contrary intention appears, it should be effective from the date the law came into effect, and therefore, accordingly, this change should also be technically effective from 1/4/1962, subject to one caveat, that if there is a contrary intention expressed otherwise, then these substituted words should apply prospectively, should not apply retrospectively. The question therefore for us is there any contrary intention available to us from the statute on this matter? The law would say all provisions of the finance bill shall apply with effect from 1/4/1922 unless otherwise stated in the various provisions of the bill. So there's nothing stated in relation to 14A. Therefore, by virtue of the express mandate of section 2 of the finance bill, this 14A should apply only from 1/4/2022, which appears to be 22-23 assessment, cannot apply for the earlier years. There is a statement for the removal of doubts is there in the explanation also. Supreme Court is saying for the removal of doubt doesn't necessarily mean it retrospective in effect. Therefore, look at the context, look at is there anything specifically mentioned by the Parliament to say it is of retrospective effect? If you look into the memorandum, it says this law, that is the change now, shall apply with effect from 1/4/2022. Memorandum is very clear. All the changes to 14A shall apply only from 22-23 assessment year. So there is an explicit mention in the finance bill, in the memorandum to say this will apply only from assessment year 22-23. So one way of looking at things would be therefore in the wake of this explicit mention by virtue of 2(1) of the finance bill backed up by the statement in the memorandum, this law should be held as applicable only from assessment year 22-23. Therefore, the old law from the way it was originally done should apply from 62 onwards till 2022 in terms of 21-22 assessment year, and thereafter the new law should apply. We can go into other instances under the finance bill itself. For the word removal of doubts, that are available at two other places. Section 37, we have an explanation in relation to what is an offense, what is prohibited by law. They have said this explanation 3, which now amplifies explanation 1, will be effective from 1/4/2022 only. So again, one more classic case where under the finance bill, we have this situation that under section 37 also, although explanation 1 itself came with effect from 1/4/2015, the amended explanation 3, which amplifies or explains the explanation 1, the memorandum is saying shall apply only from 1/4/2022. Go to the amendment to term tax in 40A2. There they say, for the removal of doubts, blah, 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 this amendment shall be retrospectively applicable from 2005 onwards. So they are very clear. When they're using the same language, in the same finance bill, 3 provisions using similar languages, they're very conscious to say one will apply with retrospective effect from 1/4/2005. The balance 2, they're explicitly mentioning in the memorandum that this will apply only from assessment year 22-23, giving therefore a possible indication that the contrary intention is available from the finance bill and the statement made in the memorandum that the amendments made to 14A shall be only prospective, therefore shall not be retrospective in effect. To what this applies? If you are looking at the incomes and the expenditure relatable to thereto. If you look into the rules that were already there before the amendment came about, the rules very clearly said, in relation to incomes that do not form part of total income or that shall not form part of total income. Rules very clearly said, although there is no indication in the main body of the statute, exempt income is what? We only all believed that it should be an exempt income that is in existence. What will become an exempt income tomorrow was not visualized in the statute, so only visualized in the rules to say, Rule 80 says, which is not taxable or which is exempt or which shall be exempt. Word shall was not in the rules. Looking at a potential future exempt income and expenditure incurred today, that linkage was drawn in the rules but not in the statute. Therefore, nobody came to the rescue of the department to say a future potential income and the expenditure relatable to thereto, are you going to disallow? Nobody came to the rescue of the department. They are now trying to address that by making in the opening portion of 14 saying notwithstanding anything contained, and again in the explanation also notwithstanding anything contained to the contrary for the removal of doubts. So in 2 sections they want to be abundantly clear now. Even in the explanation they're using the word non-obstant and also in the main body of the section concerned. And interestingly, look at the words in the explanation. Incomes not forming part of total income. That means what? Exempt incomes technically, which have not arisen to a necessity, not accrued to a necessity, not received by a necessity. So income not forming part of total income, not accruing to the necessity, not arising to a necessity, not received by necessity. It's a very, in my opinion, a very inelegant phrase. You can't talk about income not accruing. That should be a factual reality to say incomes have been earned by me and that is accrued to me. Rightly or wrongly, they're saying no. Incomes not forming part of total income, not accruing to the assessee, not arising to the assessee, or not received by the assessee. They're trying to here borrow the philosophy of the rules to say shall not form part of total income. Therefore, if at all tomorrow you get an income which today is not forming part of total income, which has not arisen to you today, which has not accrued to you today, which will be exempt tomorrow, that should be leading to a case of disallowance under 14A. As I meant, the language is not very elegant. Too many negatives there, and not accruing is not a very elegant phrase. But rightly or wrongly, they're trying to say that this type of an expenditure relatable to an exempt income tomorrow. Now, exempt income by what character? By what law? Because look at the classic case of dividends. Assuming for a moment this was there last year itself, when the dividends in the year of expenditure was exempt, but dividend when earned became taxable. So I therefore I incurred an expenditure in a year in which year my investment in shares was there, and if I had earned dividends, then the dividends would have been exempt. But the law thereafter got changed to say, no, dividends are going to be now taxable. And therefore, what will happen to those situations concerned, where in the year of incurrence of an expenditure, had the income been earned then, you would have said, this income would have been exempt, therefore I'll disallow the expenditure. But now if the law changes, and law makes that income taxable, how you are going to come to a situation that this income will be exempt tomorrow? Where is the definitiveness to say that this income shall necessarily be exempt tomorrow? So that's going to be a very tough question to answer, to say that how are you going to make a categorical statement that the expenditure today in relation to particular income shall be exempt tomorrow? It can happen in relation to definitive incomes, like bonds, where getting that by government has committed to you to say, I'm going to give you 6%, 7% interest, and that interest will be tax-free. Possible. But otherwise, there's going to be a very difficult issue to come to a conclusion regarding an expenditure about a potential income and the exempt nature of that potential income shall be, therefore, it will not be taxable. That's the certainty I need to draw today to make a statement that this expenditure shall be disallowed. That's going to be a difficult situation, in my opinion. And exempt incomes, therefore, would be a situation where you go to have Section 10 incomes largely. That's what we discussed, 10.1, 10.2, 10.2a, 10.46. There could be various other sections under the Act, and nothing new. I just make an outline of those sections concerned. For example, if I'm a partner in a firm and the salary is drawn by me, but some portion of the salary is disallowed because the book profit of the firm is lower, and therefore I get some portion of salary not taxable in my hands. So I've received 100 rupees of salary, 80 rupees tax, 20 rupees is not taxable by virtue of 28(5) proviso. Is the 20 rupees not taxable, and does it give rise to an exempt income? Or the law says your income shall be adjusted. They don't talk about an exempt nature of the income concern. They only say income shall be adjusted. Therefore, possible for us to say that this 20 rupees, which does not suffer tax in the hands of a partner, is not exempt income. It got adjusted for the reason that they had a mechanism of allocating the total income, some to be taxed in the partner's hand, some to be taxed in the firm's hand. And that allocation mechanism operated in a particular manner, not necessarily giving rise to an exemption to the incomes concerned. 86(1) would tell you that what is taxed in the hands of the AOP at the maximum marginal rate in the hands of the member concerned will be not taxable, will not form part of total income. Therefore, you have a situation of an exempt income, not necessarily confined to Section 10 or Chapter 3. You can also find illustrations outside in Section 86 of the Income Tax Act. The whole attempt, therefore, would be to ensure that expenditure referable to an exempt income will not be allowed as a deduction. We need to also draw at this point of time a distinction between an expenditure referable to a potential future income and a wasteful expenditure. A wasteful expenditure does not give rise to income. That's the way we call it, as a wasteful expenditure. If I started a project concern, I gave it up because of some reason. That's a wasteful expenditure, doesn't give rise to income today or will not give rise to income tomorrow. That wasteful expenditure is not to be covered by 14A because the income, had it arisen in relation to that activity or that outlay, would have been taxable as such. So wasteful expenditure doesn't give rise to 14A attraction. So only that expenditure referable to an income that will be exempt tomorrow. Therefore, the proximate nexus between the expenditure you're incurring today and the income that is going to arise tomorrow, that needs to be established. And therefore, proximate expenditure only will be coming about. Having understood this law, Explanation in the last portion nullifies the entire discussion we have had till now, because the last portion of the explanation is very interesting. It says that this qualification to say that income shall not form part of my total income, income not accruing to me, income not having received by me, all that is fine, expenditure relatable, therefore to be disallowed, all that is fine. But the last portion of explanation says, but in relation to income, that does not form part of total income. Income that does not form part of total income. That means it's again making a mandate to say that by virtue of the last portion of the explanation concerned, the income has to be present for you to apply 14A. If the last portion of 14A had not been there, it should have done the purpose, it would have served the purpose of the government concerned by making a disallowance. But the last portion, having said all of this in the initial part of the story or initial part of the section, the last portion of 14A says this expenditure shall be allowed, will not be allowed as a deduction if there is income that does not form part of total income. So the mandate of a presence of an income is there in the last portion of the explanation to 14A, and people who want to take advantage of that, then they can go back and say, look here, nothing has happened by virtue of the new law. They are reiterating the whole issue, and if there is no income concerned there's no question of applying the entire new law at all. So there is, in terms of the lacuna wording there, inappropriate words being used there, or excess words used there, which are not actually required. You will come back to a situation where the old law should continue to apply technically. We then go to section 17, which talks about expenditure, which gives rise to a perquisite. So there are various clauses in 17 to say the perquisite shall include the following. There are exemptions to say the perquisite shall not also include the following. And there are certain exemptions relatable to medical. One they say is where medical expenditure is incurred on an employee concerned in a hospital maintained by the employer himself. So whatever be the expenditure incurred, whatever be the type of disease you are having, whatever be the quantum of expenditure incurred, exemption is available. It continues to remain available today. So even a COVID-related expenditure in relation to a hospital maintained by the employer shall continue to remain exempt regardless of the limits. There is explanation limb 2 there, which says that I'll give you certain exemption provided your expenditure is in relation to an illness, and that illness is treated at a hospital owned, operated by the government, or where the government says my employees, that is employees of the government, are going to be treated there. There's one more limb to that which says for prescribed diseases in approved hospitals, you will get an exemption. Now, that talks about technically a hospitalization. The current rule, if you read that very literally, talks about exemption for approved diseases or for specified diseases in approved hospitals is only on the condition that you are hospitalized. Otherwise, you don't get. So COVID-related diseases possibly may require hospitalization, may not require hospitalization. The government came out with a circular in notification to say, we'll give you an exemption in relation to COVID treatment concern. Therefore, we'll like to give you certain relief. But that relief may not necessarily or invariably lead to an hospitalization. Therefore, there is a need for having a specific regime there to say that, yes, clause C has been added to this hospital that are there to say, if you are incurring an expenditure, that is, if the employer is incurring an expenditure for the treatment of the employee or any member of his family, then expenditure incurred shall not be regarded as a perquisite because it's relatable to COVID, illness relatable to COVID. Again, no exemptions, no limits on exemptions concerned, that will be allowed to you as a deduction. There's something available on 56. We will see that when we come to section 56 in relation to the exemption when a person gets certain monies to take care of the COVID-related expenditure. There is section 35. An amendment had been made last year for certain associations, universities. You are making a contribution to that. When you make a contribution, you are entitled to certain deductions. These deductions are conditional upon certain fulfillment or certain criteria being fulfilled by the eligible association or university or a research body. What were there? There has to be a specified services being performed. A report has to be prepared in relation to those services, and you give that report to the prescribed authority. And that institution or university gave you a certificate or a receipt for the donation made by you. These were the conditions. So when these conditions are made and you made a contribution, you are entitled for certain exemptions. Rightly or wrongly, amendment made last year said the exemption is available to the fellow who is receiving the money. Deduction shall be available to the person who is receiving the money. That is a goof up, there is a slip in the law concern that they have rectified this year. Therefore, they have corrected the position of law concern to say that the deduction shall be available to the person who is contributing. The law last year made a mess to say it will be a deduction available to the person who receives the money. No. Correct way would have been to the person who is contributing the money. That has been now rectified to say, yes, the person who is making a contribution will be entitled to the deduction, provided those conditions that are already incorporated continue to be satisfied by the association or the body concerned. We then go into section 37. Some portions of it you already seen in the course of discussion on 14A, the retrospectivity we have seen. In section 37, we had an explanation which says that any expenditure which is towards a purpose which is an offense or which is prohibited by law will not be allowed as a deduction, because that expenditure shall not be deemed to have been incurred wholly and exclusively for the purpose of business. Therefore, that expenditure deserves a disallowance. What type of offense? Where prohibited? There are no clarity. Mylan's case, Hyderabad tribunal, offenses outside, penalty paid to you law there outside. The question is, does it deserve to be disallowed here? Hyderabad tribunal came in favor of the assessee by principles to say that offenses what are contemplated possibly can be offenses or those prohibited by the law in India only. To get over that, they're amending the law now to say that what is prohibited, what is an offense, shall be regarded as an offense or a prohibition by law, not only with reference to the Indian law, but any other law for the time being in force anywhere else in the world concerned. Therefore, as chartered accountants, when you're certifying this, be sure you will know every law in the world to say whether there's a violation of any law in the world concerned. If that were to be, you can certify the 3CD to say, in our opinion, there's no violation of any law in force in the world at all. You can't even take a management certificate because he says there's no violation by me. I say because management says there's no violation. I'm also saying there's no violation. But anyway, they've made a statement now to say that, yes, this type of an offense anywhere in the law will not, the expenditure in relation thereto. Expenditure in relation thereto. That means if you've taken a lawyer to defend you also, that will also be a case where it is expenditure in relation to that offense, expenditure in relation to a purpose is prohibited by law. Therefore, all those associated expenditures with that offense will be covered by section 37, explanation 3. Now, if there is an offense committed by me, I can go and compound that. And possibly the effect of compounding is that I never committed the offense. Therefore, I'll make a statement, therefore, I never committed an offense. Where's the question of there being an explanation one attracted in my case. Therefore, they're now covering the situation by third limb of explanation 3 to say, when you're compounding an offense, whether in India or anywhere else in the world, expenditure incurred in relation to that compounding shall also be regarded as not laid out wholly and exclusively for the purpose of business. So anywhere offense in the law and a compounding that offense, this expenditure in relation thereto will not be allowed as a deduction. There's one more second limb, and that's the relation to what we all believe is the pharma companies, where you are giving a benefit to a doctor concerned and making a statement that I am entitled to a deduction. Question therefore was that the doctor accepted those gifts in violation of the regulations concerned. But the courts came to the rescue of the assessee concerned in a number of ways. They looked into circular number 5 of 2012. Therefore, they said, what is now being disallowed is by virtue of circular 5 of 2012. This circular is only for the first time making a disallowance now. Therefore, anything that is relatable to an year prior to the issuance of circular cannot be therefore disallowed under section 37. So they came to the rescue of the assessee concerned. 2, they said, on whom is the violation? The violation is on the person who is receiving it. Where is the violation? Under the MCI guidelines. Is there an MCI guideline applicable to the pharma companies who is giving it to you? No. MCI guidelines don't apply to the pharma companies. Therefore, how can I be governed by the pharma companies? When I give, that should be allowed to me as an expenditure because MCI guidelines don't apply to me. Therefore, they came to the rescue of the pharma companies concerned, some courts, to say that this will not be allowed, this will not be prohibited, it will be allowed as a deduction to you. There are also contrary decisions. But then these were two broad reasons to say that these shall now be regarded as allowable expenditure. Therefore, they brought in an explanation now to say that if it is prohibited from a recipient's point of view, then it will not be regarded as an expenditure wholly and exclusively incurred for the purpose of business. So now, When I give which is an offense, explanation 1 will get attracted. From the receiver's point of view, if it was an offense, explanation 3 gets attracted now. So therefore, you can't take a stand that now the recipient is prohibited, but I'm allowed to give. No, if there is a prohibition on my side, then explanation 1 will take care. If there's a prohibition from the recipient's point of view, explanation 3 will take care. So either way, therefore, it will be a case where you're going to have a situation of disallowance getting attracted. Now, what is covered by this explanation? Any benefit or perquisite in whatever form. Any benefit or a perquisite in whatever form. You don't have a words, any benefit or a perquisite, whether convertible into money or not. Those words are not there in explanation. That second limb of explanation 3, whether convertible to money or not is not there. You'll find this, let us say, for example, in the 194R, which we're going to discuss a little later, or you find it 28.4, any benefit or a perquisite, whether convertible into money or not. In that context, Supreme Court in Mahindra's case 404 ITR said, benefit or perquisite, whether convertible into money or not, necessarily refers to a cash benefit, cannot contemplate something in kind. Now, if you look into the wordings now under section 37 explanation, they only said benefit or a perquisite in whatever form. Question therefore is cash a benefit? Obviously, answer is yes. It may not be a perquisite, but is it a benefit? Yes. So technically, therefore, one can make a statement that cash benefits given to doctors or to anybody which is prohibited by law will also get covered by virtue of the wide coverage of the limb there. Any benefit or perquisite by whatever name called. There is actually an old circular on this matter. I'll give you the circular reference 20/D, dated 7th of July 1964, where they said any benefit or perquisite. Those were the words used, not qualified by whether convertible into money or not. Board in 1964 also said cash will also be covered or will get covered under the terms benefit or a perquisite. And that's what they're clarifying now by the phraseology used today, that this benefit or perquisite, whether it's in cash or in kind, will get covered and therefore will be liable for disallowance. You may ask some questions now. Various type of illustrations in relation to doctor's concern. What happens if the doctor is sent for a seminar like this? You can get so many illustrations of this nature. What happens if a doctor is given free samples? What happens if the doctor is given a diary? What happens if the doctor is given a genuine gift? So in relation to a gift that is given, we're able to very clearly say the personal asset given to him, personal benefit given to him, covered by that. Question therefore will be difficult in situations where we have cases of gift being given up to a limit. MCI guidelines also permits it up to 1,000 rupees per doctor, they allow you. So that will be a permissible gift by virtue of MCI guidelines, because accepting that much of gift will not be an offense, is not prohibited by the guidelines concerned. Otherwise, you'll ask questions in the relationship between the doctor and the pharma company is concerned. So many types of relations may emerge between the doctor and the pharma company. Question therefore is a free medicine or a free sample of medicine, is it a benefit or perquisite? Therefore, will the pharma companies get disallowed? Or is going to be regarded as advertisement and sales promotion expenses? What happens to a doctor's conference expenses being met? Travel expenses for the conference being met? Question therefore for us would be, in all situations concerned of this nature, we have to go back to what? The law, the rule, the regulation, or the guideline. Ultimately, therefore, the guideline should make it prohibitory for the doctor to say that you shall not take a free sample. You shall not attend a conference. If there are those regulations and explicit mention, then possibly you can make a statement that yes, the guidelines are making those very explicit, and therefore there's a prohibition allowed, there's a prohibition mentioned there, therefore the expenditure in relation to those items will not be allowed as a deduction. But if otherwise you are making a statement that there is nothing mentioned, then you will go back to say the hospital is interested in the doctor getting updated. Because he wants the best quality surgeons, he wants the best quality doctors concerned, is looking at the best quality of services, and therefore in the interest of the hospital, they're saying that doctor attend the conference concerned, he will get these skills involved, you will get therefore a better quality of service, my patients are going to be better, they're going to be more happier, and therefore this is solely for the purpose of the benefit of the company, the benefit of doctor is incidental. So in these situations concerned, ask questions, go back to the regulations, go back to the guidelines concerned and say what is permissible, what is prohibited. Only then draw a conclusion. If there is an explicit mention made that this is prohibited, fine, that's a bar. If not specifically mentioned, then ask a question whether it is the benefit of the company largely Or is it a benefit in actually to a doctor concerned? Camouflage does a benefit to the company concerned. Those questions will have to be necessarily asked by us before we come to a situation whether the expenditure incurred by the pharma companies will be allowed as a deduction or not. This expenditure that has been added is, we discussed, effective from 1/4/2022. We already made a statement that explanation 1 was with effect from 1/4/2015. Now, there is a circular that was there from 2012. Question therefore is, yes, explanation 1 is applicable from one date, thereafter is okay. The question therefore is the period between the circular and the law now. The law is applicable, explanation 3, to say from a pharma company, disallowance will happen only from 1/4/2022 onwards. Question therefore is, what happens to the period prior to the law from the date of the circular concern? Are you going to now say the circular is in force, therefore I am going to disallow the expenditure? Or as an assessee, you are going to say, what is the meaning of a circular? Circular not binding on an assessee, not binding on an assessee, I can ignore the circular, therefore apply the law. After having ignored the circular, therefore I'll ask for a request or make a request that the circular may be ignored. This is one way of looking at things. The other way of looking at things would be what we discussed, that this is an explicit statement made by the parliament that this is a law applicable from 1/4/2022 onwards. That means anything prior to that should be regarded dehorse the circular. The circular, therefore, contrary to the provision of law, because there's no provision of law. The provision of law is only coming from 1/4/2022 onwards. You can only make a statement that in spirit, yes, but then, in my opinion, the better way would be that the parliament is now making an explicit mention or making an explicit statement that this shall be applicable only from 1/4/2022. The context being set now, contrary intention being appearing today. Therefore, from 1/4/2012 onwards, when this circular came into picture, today, now, you can make an argument now that the circular needs to be ignored. Circular is contrary to the provision. Therefore, I should be able to get the expenditure for all pharma companies up to 2022, up to 2021-22 assessment year. What happens in relation to payments made after this date? They're going to be disallowed? The answer is yes. What happens to the doctor concerned? In the hands of the doctor, he'll continue to remain taxable under 28(4). The disallowance in the hands of the company does not mean it will be exempt in the hands of the doctor. 48(2) disallowance can happen in the hands of the company. In the hands of the relative, it will remain taxable. So there could be double taxation in the hands of the company and the doctor's concerned. What happens if it gets disallowed in the hands of the company by virtue of explanation now? Would the company be required to comply with the provisions of 194R? 194R is regardless of the permissibility of the expenditure, allowability of the expenditure. 194R doesn't say if it is allowed, only says if I'm making a benefit or a perquisite. There are peculiar wordings of 194R, we'll come to that little later. I have to ensure that tax has been deducted, but nevertheless, what I'm trying to make a point now is that the disallowability in the hands of the company does not give rise to the negation of 194R. 194R should continue to remain applicable. If you don't comply with 194R, what happens? 40A technically should be the disallowance section. I should therefore say I have not complied with 194R, therefore I should have a sufferance of a disallowance under 40A. But then before that, section 37 itself disallows me because this is an expenditure referable to a prohibited item. So section 37 itself disallows me. I don't have to traverse to section 40. What passes through section 37 can only be the subject matter of a disallowance under section 40. Therefore, the question of disallowance under 40 remains to that extent meaningless. The law says the person who is accepting the gift, whether or not he is in a business or whether or not he is carrying on a profession. So anybody who gets a gift, I don't have to make a statement that he is carrying on a business, he is carrying on a profession. Because, for example, a government servant may be prohibited from accepting so many things concerned. That prohibition may continue even post his retirement. So as long as he is working, he is not carrying on a business, he is an employee. Even after retirement, he may just be keeping quiet. But if there are regulations to say even post retirement, you can't accept gifts concerned, the person who is accepting a gift, if he is now told by the guidelines concerned that you cannot accept the gift, he's a person, he's not carrying on business, he's not carrying on a profession. But then from the point of view of the company paying that item concerned, disallowance will still be attracted. They could be doctor employees. They're not therefore carrying on a business. They're employees of the hospital concerned. They take a gift from the pharma company. They're not carrying on a business or a profession. Therefore, the law is very clear in very widely worded to say whether or not you're carrying on a business, you will be faced with the disallowance in the hands of the company or the pharma companies concerned. Section 40 amendment brought about. There was a circular issued in 1967, 1967, in a different context to say cess is allowable as a deduction. Latching on to that, we've had recent case laws to say cess, by Shesha Gova's case and a number of other decisions thereafter to say cess is permissible as a deduction. Question was there anything in favor of the department even without this amendment? So we had this Srinivasan's case, 83 ITR, to say that the tax includes cess and surcharge. Therefore, it was a part of tax. Chythanya was referring to, gave us the case law of Smith-Kline French, 219 ITR 589. The Supreme Court already has said that tax includes cess and surcharge. So there was actually no need. The law was so broadly worded, the decision was so very clear that cess and tax cess and surcharge are a part of tax, and therefore 40A2, which talks about tax by virtue of the Supreme Court decision, should have been held as inclusive of surcharge and cess. There is no need, therefore, of an amendment. But then in an anxiety, because too many people were blindly following the Shesha Gova's case, high courts and tribunals, and therefore too much of relief was available to the SSC, they therefore said it's better for us to address this issue by making a retrospective change to law and define tax with effect from 1/4/2005 to include surcharge and cess. Therefore, we began finding out what could be the lacuna in the government's effort on this matter. Very obvious, no? Cess, tax and cess are part of, surcharge and cess are a part of tax. Very easy. So now we start finding faults where the government has gone wrong. So we began looking into 40A. Look at what happens. 40A 1B says equalization levy will be not allowed as a deduction. So if there is a surcharge or cess on equalization levy, that will not get covered. It will still be allowed as a deduction because they've only amended 40A2, not amended equalization levy. If you look at 40A1C, it talks about FBT. From 2005, 6, 7, 8, FBT was applicable. So now FBT had a surcharge and a cess. They've only amended 40A2. So surcharge and cess on FBT, will it be allowed as a deduction? If you go by this amendment, you start making fun of all of this. 40A3 talks about wealth tax. Wealth tax is not allowed as a deduction. Will surcharge and cess on wealth tax be allowed as a deduction? So you start making, you should have left it alone, kept quiet about it. But you started making an amendment to only one of the limbs concerned to say, for this section, now retrospectively, tax shall include surcharge and cess. So we just had some fun. Technically, Supreme Court decision should trouble us. But looking at what the law is now trying to develop further to confirm that Shesha Gova is right to the extent of everything else other than tax, as covered by 40A2. Some people could have some fun about this aspect concerned. What happens to, therefore, when you're having a retrospective change of law, a retrospective amendment to the law now? So your assessments are over, assessments are pending. If they're pending, we'll have a difficulty. If the assessments are over, can there be a rectification or 154 times available to you? In my opinion, the answer is yes. Saurashtra Kutch Supreme Court said what? You could have a 154 even when there is a decision of the High Court or Supreme Court subsequently. The subsequent decision will explain the law retrospectively, and therefore you could have a 154. Today, this law is also retrospective in effect to say that I am going to change and clarify the law from 1/4/2005. 154 may be possible. 147 is anyway possible under the new dispensation. We'll discuss about that a little later because now it's very liberal. 263 also may be possible because of Max India's case. To say that, yeah, this could be a case where the CIT may exercise its revisional powers and say that income has escaped. There is a revision, order requires therefore to be rectified or revised to the extent of disallowing the surcharge and cess on this aspect concerned. 43B. $250 and $254. Yeah, the question therefore is 254(2). Can you therefore have an application to say that I want that I am mistaken in the order made by the tribunal to be rectified? Supreme Court decision, Saurashtra Kashmir says, again will say that possible to make an application and have the department can move that and provided the limits are there. Now, again, there is a controversy on the limits concerned. 6 months limit is there. Everybody is blindly applying the limits. So look into the law very closely. It's 6 months time only for the tribunal to suo moto. The department and the SSC will have no time to have the mixture rectified. But then the tribunal is all applying for all the parties concerned 6 months time. That's an incorrect application of law. But if you think you can They'll convince the tribunal that there is a delay by the department beyond 6 months' time, and the tribunal views in your favor. Possibly you can prevent that rectification by an application under 254(2). Again, small change in law, but having wide ramifications. 43B. You're making small amendment without understanding the repercussions elsewhere. You're trying to be overcautious or over anxious, and therefore says something has gone wrong with the assessor concerned. I want to therefore tackle that strategy adopted by the assessor. This was not a strategy by the assessor. It was a conclusion by the Supreme Court in Aqua's case. Supreme Court said when you are having a interest due on a loan and you convert that into another instrument, debenture concerned, will that amount to a discharge of the interest? If that is a discharge of interest, then 43B, which talks about interest payable to particular assessors concerned. If you have to actually pay, 43B talks about actual payment. So there are three clauses there, Clause D, Clause DA, and Clause E. Talking about, Clause D talks about interest paid to a public financial institution, state financial corporation, or a state industrial investment corporation, Clause D. Clause E, D8 spoke about a deposit taking non-banking financial institution or a systemically important non-deposit taking NBFC. If you take an interest loan from them, you're paying interest, Clause DA would have covered that. Clause E talks about loan from a scheduled bank and cooperative bank. There's certain exception to cooperative bank. We'll not go into that. Taking a loan and you're paying interest to this. 43B made a statement that this interest to all these institutions will be allowed as a deduction only on the basis of actual payment to the bank's concerned. If you therefore converted your loan to another instrument, debt instrument, typically before the Supreme Court in a debenture, which the borrower accepted, question was, did it amount to a discharge of the interest concerned? And Supreme Court said, yes, it amounts to a discharge of the interest concerned. Therefore, 43B, the prohibition will not be troubling you. You'll be therefore able to make a statement, interest has been paid, therefore it will be allowed to you as a deduction. What did the main body talk about? Interest on what? Interest on loans and borrowings. Loans and borrowings. What they're trying to add now? Loans and borrowings, debentures and other similar items. Okay, now they're adding, now they're trying to be very, but to get over the Supreme Court decision, you're now adding those words in all the respective clauses concerned, not just loans or borrowing, but also debentures and other instruments. Other instruments could be of something of similar nature, could be like a bond, could be deposit, could be anything. So they're trying to be a little more cautious, anxious by making an amendment to say debentures are also covered now. Therefore, unless you make a payment actually, only then you will be allowed. By issue of a debenture or by issue of a loan, if you are deferring the date of payment concerned, it will not be regarded as a discharge of the interest concerned. You will therefore continue to have the interest disallowed because there is no actual payment of the interest concerned. We are adding the terms borrowings, loans are there, and you add debenture. Therefore, the question arises, is debenture different from a loan or a borrowing? If debenture was a loan or borrowing, it is already covering there. So what is the purpose of adding now a debenture separately and along with loan and borrowing? Is the law now trying to make a conscious statement now, rightly or wrongly, that debenture is different from a loan and a borrowing? There is no need of amending it. If there is a situation now that by virtue of the amendment so made by the government, you are now getting an inference that debenture is different from a loan and borrowing, it gives rise to a lot of consequences under the statute. Take 222E for example. Loan or an advance. The word used are advance or a loan there. Now, advance or a loan only is covered if a company issues debenture. Now, are you going to make a statement that debenture is different from loan and borrowing? That's what 43B is telling me. Therefore, debenture otherwise would have covered by 222E because it is a loan or advance to somebody to whom you are prohibited from making that advance concern. But the law is now making a statement, no. Debenture is now distinct, different, not equivalent to loan or borrowing, loan or advance. Therefore, I'll be able to get that debenture issued without attracting 222E. So therefore, you're giving rise to, you start examining 269SS, you start examining 269D. The word used are loan and deposit there. So you start examining all of this concern to say wherever is the word loan, borrowing, debenture, if there's no making a statement, debenture is different now, you're going to make a statement that the consequences attaching a debenture and the consequences attaching a loan or borrowing are going to be different, because the law itself is now trying to draw a distinction between these two terms by virtue of the amendment made to 43B. So you're going to have needless controversies as a result of the spillover effect of an amendment made to one place. They're trying to be overcautious by looking at Aqua's case decision and saying that, look here, there's something to be done now, and therefore you're trying to be protecting ourselves by adding debenture to 43B, various clauses concerned, not understanding to say that it could have some serious repercussions elsewhere that may go against the department concerned. One word, one letter in section 50, and look at the complication it is causing, is in relation to depreciation on goodwill. What the law is saying, I don't want you to get depreciation on goodwill. So remove the effect of depreciation from your WDV. Remove the effect of that. We want you to therefore not claim depreciation. That's one part of the story. But then if you only make this statement that you're not entitled for depreciation on goodwill, and the block contains so many assets, I'm not able to identify what is the WDV towards goodwill. So if you make a statement that no goodwill and no depreciation on that goodwill, it doesn't serve the purpose, because the block may have so many other intangibles. You'll therefore say block is one, I'll continue to claim depreciation on that block, irrespective or regardless of your statement that no depreciation is available on goodwill. So you address that now. So how do you address that now? You start making a change to 43.6, which talks about written down value. Definition is there. You make a statement, therefore, that written down value of the intangibles shall be reduced by the WDV of goodwill. Shall be reduced by the WDV of goodwill. What is the WDV of goodwill? Imagine goodwill were to be the only asset in that block. Calculate the written down value on the basis of this fiction concerned. And this amount that's so arrived at should have been the amount reduced from the block. This is the fiction. Now, they should have stopped there. They should have stopped there to say, on a standalone basis, the WDV of goodwill shall be reduced from the block value. They stopped there. They went on to make a statement that this reduction shall not exceed the WDV. This reduction shall not exceed the WDV. That was needless at the end of 43.6. Rightly or wrongly, they should have only stopped saying that the notional value of a goodwill on a fiction that this is the only asset in the block, whatever you get, that shall reduce from the WDV. Then we look at the consequences thereafter, because this reduction on a notional value of goodwill could have resulted in a negative block value, could have resulted in a positive block value, could have resulted in a nil block value, could have been so many circumstances concerned. And we are concerned, therefore, by what happens is that there was an IPR sale earlier, gave me good money. As a result of that sale, the entire sale proceeds went to compress my block value of intangible. There's no low value now. If I remove the value of the goodwill on a standalone depreciable basis, possibly it will result in a negative value. Therefore, there should have ideally been the situation concerned that it should lead to a negative value, and we'll provide for the consequences elsewhere. Possible we'll make the statement that this negative value shall give rise to capital gains. Rightly or wrongly, having made the statement initial portion, they said that this shall be restricted to the WDV. Therefore, you can't convert that block into a negative figure. Now, this is the position of law. They come to section 15 now to say that this reduction of goodwill from the block shall now be deemed to be a transfer. It happens in section 50. Shall be deemed to be a transfer. Otherwise, what should have happened is interesting. Look at the situation concerned. That a reduction from the block, is it a transfer at all? It's only a book entry, technically, an accounting entry, an offline entry. It's not a transfer. So a reduction does not give rise to capital gains regardless of what is spoken under 43.6. Even if the reduction of goodwill would have resulted in negative value, wouldn't have meant anything, because the law is not talking about a transfer at all. It's only talking about a reduction. There's no change of ownership. There's no change of the title passing over. Therefore, reduction wouldn't have given rise to a transfer. Therefore, there wouldn't have been any capital gains. Imagining that they're trying to address the situation concerned, that this reduction shall be regarded as a transfer of a capital asset. They've forgotten the fact that that reduction shall be resulting in a nil WDV, cannot result in a negative WDV. They've forgotten that. So look at this impact of this now. It will be a transfer to section 50. Will it give rise to capital gains at all now? Even that reduction can only be limited to the book value. Can't go beyond the book value. 1. 2. This reduction will maybe regarded as a transfer. Now, transfer to whom? Transfer to whom and transfer for what? I am retaining the asset myself. I am yet to transfer to anybody else. Therefore, they should ideally amended 247 to say, like a stock to capital asset conversion or vice versa, that will be a transfer. They should have amended there. They have not done that. So today, a reduction being a transfer is contrary to 247. One part of the story. Second part of the story, assuming for a moment it is transfer, what is the consideration I've got now? I've not received any consideration from any third party concerned. And the fiction of 43.6 is limited now. So it will be deemed to be a transfer, but cannot give rise to capital gains at all. And the asset has now moved out of the block. Are you happy now to say the asset has moved out of the block? It's no longer a part of the block. When I sell the goodwill tomorrow along with my business, Section 50 can get attracted on that sale, provided that goodwill is a part of the block of assets. The opening condition of Section 50 is where there is a block of assets and the sale price from out of that block is in excess of the written down value of the block, or when the block ceases to exist. So the precondition for Section 50 to be applicable is that the concerned asset should continue to remain or form part of the block of assets. Goodwill has moved out now. So when goodwill is sold tomorrow along with my business, because goodwill is remaining with me, the only thing is I can't claim depreciation. If I sell my business, that business, and I transfer goodwill along with it, question therefore arises is, when I'm transferring that goodwill along with my business, would Section 50 be attracted? No, for the reason that it's not a part of the block of assets itself. So 50 cannot be attracted. What will happen then? I'll be able to get normal capital gains. 55 will come into picture to say the cost of goodwill was the original cost acquired by you minus the depreciation claimed by you. The resultant goodwill income could technically be long-term capital gains. What is the argument I'm going to make? Long-term capital gains by virtue of this analogy, fine. But you have already created a fiction that in the year of reduction, there is always a transfer, already a transfer. So where's the question of second transfer now when I ultimately sell the goodwill 2, 3, 4 years later? You already created a fiction that this is a transfer. Therefore, the consequences of transfer are already provided for. Right or wrong, there may not be an income. That's a different issue. But the factum of the transfer is already acknowledged. Therefore, when I sell the goodwill tomorrow, that goodwill should not give rise to any capital gains in my hands at all. Although 55 may provide for it, but there cannot be a second transfer. This is a case of a JDA in revenue sharing. If I make a statement that for a non-individual, a JDA entering into is giving rise to a transfer on the date of revenue sharing agreement. Ultimately, therefore, I'm paying tax on 1 crore rupees. But because of the revenue sharing tomorrow, I get 5 crores. On the differential 4 crores, I don't pay tax all over again because there's no second transfer by me. The transfer is already accomplished by me in the year of JDA when I paid the tax concern. Therefore, a situation can arise now by virtue of the small statement, but giving rise to a lot of complications concerned, that this goodwill can give rise to no tax at all, either in the initial stage or in the final stage, something that they had not visualized, but that is the impact of what's happening when you read all of this concern. Some may say that look at 8AC, Rule 8AC. If you look at Rule 8AC also, you cannot get a conclusion contrary to what we have discussed today. And therefore, there could be very interesting consequences of goodwill being transferred now. Now, I made a statement that there is no consideration on this reduction from the block value. And the deemed consideration concept under 50C or 50CA or 50D will not apply to your goodwill. Therefore, you don't have a fictional consideration deemed to have been received. Therefore, you have to go back with the actual reality, see that the consideration is received or not. The deemed or fictional consideration under the respective sections will not at all apply. In the case of an ESOP, the date of exercise is the date on which you take the value. Year of allotment is the year of taxability. So they're only looking at taxability defined. Value is different. So you're not looking at two different transfers. They're only making a statement that in the year of allotment will be taxed. But what is the value? I'll take the value on the date of exercise. That's the only difference. There's no double transfer there. I didn't get that.
One as a perquisite and another as a capital gain?
Therefore, I now have paid tax as a perquisite. Then I become a shareholder. I have got this shares in kind from my employer for services rendered. This is therefore a salary taxable by me. So the employer, instead of giving me cash, has given me asset in kind. That has become taxable as perquisite. This asset I'm holding as a shareholder now, I can transfer it tomorrow. That's a second transfer, first from the employer to me and from me to somebody else, therefore. From my side, there are no two transfers. That's what's happening in goodwill, therefore. (56)(7)(b), we have had an amendment to say that a unlisted company which gets unjustified premium was to be taxed. Therefore, they made exemptions to say that a venture capital undertaking getting money from a venture capital fund or a venture capital company or a specified fund, monies from these people towards shares, you will not look at the unjustified premium. Therefore, you don't tax the receiving company. To the extent of specified fund, an amendment has happened now. They're also referred to not just the SEBI Act, they're also looking at the IFSC regulations concerned, and they're giving an exemption that a specified fund governed by the IFSC regulations and the money received by a venture capital undertaking will not have the rigors of 56(2)(7)(b) attracted in the case of that person concerned. 56(2)(10), this is the last section I will discuss with. Two clauses have been added, largely to take care of the COVID relation. And look at therefore, we were discussing, and look at the inelegance of the entire process itself. As far as the SSC is concerned, we have seen SRS discussing so very carefully, so very meticulously. I'm trying to address all situations concerned. When it's giving relief to an SSA, I'm a little casual. I don't look at the law. I don't look at the difficulty SSCs face. And if I look at the law very seriously and critically, I may not get the exemption that the government is trying to give me under 56(2)(7). What do I mean by that? The government is making a statement that anybody who is suffering from COVID, any money given to the family or to the individual concerned should be exempt under 56(2)(10). That's the way it is. Now, what is the law telling us now? Therefore, I'll give an example directly without going into the law. Law says who will get an exemption? The person, individual, if he is suffering, or any member of his family when he dies. So individual, when he gets, from his employer he may get, from third persons he may get. So he will have certain exemptions available to him. From the employer, no limit. From somebody else, aggregate of 10 lakhs. We will therefore say, subject to certain conditions, central government guidelines, 12 months, all, and we will look into all those a little later. When he therefore gets the money from an employer, no limits, from a third person, he will get exemption to the extent of 10 lakhs. Now, if the individual who is suffering from COVID dies, who should receive the money? His family members. If the family members receive the money, then in the hands of the family members, it will not be taxable. So that's a very easy law for us to understand. Start questioning what is the way in which the law is worded now. So they say individual, when he dies and his family members receive the money, then his family members will get exemption under 56(2)(10). Who is the family member now? Family members as defined in 10(5). Who are the family members as defined in 10(5)? The spouse or the children. And the parents, only if the parents were dependent upon this fellow for support and maintenance. Otherwise, no. Otherwise, only spouse and the children concerned. Look at a case of a fellow who is young, unmarried, who dies. His parent received the money from so many people. When the parent received the money, is it received by a family member? They don't talk about the person who died who was a part of the family. Not saying that. The person who died was a part of the family. Then, yes, father and a son, that would have been a part of the family. The father getting it, it would have been an exemption in the hands of the father. They're not saying that. They're saying with the individual, his family. Therefore, this fellow was not working. Therefore, the question of his parent being dependent upon him for support and maintenance doesn't arise. Therefore, now, when the fellow dies now, and the monies are received by the people concerned, are you going to make a statement, look here, the money has been received by a person other than the family member as defined. Therefore, it's taxable. We are making, therefore, this is casualness in terms of giving an exemption to somebody else here. 1023C, we had so many specified dates, specified violations, specified inaction, withdrawals, so many compliances. Here we are little casual. On a very strict reading of the law or a very literal reading of law, one may make a statement that this amount is going to be taxable. The law is very inelegant. Look at the first portion, limit 12. They say, when the individual has already incurred an expenditure and what is reimbursed to him, then only it will be exempt. So the employer were to give an advance to an employee concerned to say, take this money and take care of your expenses concerned. We will have to go back to the courts to say, that the advance is equivalent to a expenditure incurred by me, a reimbursement by virtue of my actual spending it tomorrow. But then law could trouble you. We have had case laws on this matter in the context of medical allowance under section 17. The law talks about reimbursement. What happens when an advance is given? Courts have come to the rescue of the SSC concern to say an advance given, if it is actually spent, shall be equivalent to reimbursement only. But if you look at the law very literally, ITO will say, no. Demonstrate to me you incurred the expenditure first. If you not incurred the expenditure, I will not give you the exemption under limb 12. It's going to be a difficult situation for us as concerned to fight the battle. And the central government also is saying this exemption is subject to the restrictions or conditions I may prescribe. Difficult situation again. So there are a lot of difficulties in the way the law is therefore designed. So we should take advantage of some other situations concerned. So what are those situations where we can take advantage? And therefore we'll look at the lacuna in the law and give those illustrations concerned. The law would say that it shall be 10 lakhs exemption. To whom? To the member of the family. The law would say this amount has to be spent by you or received by you within a period of 12 months from the year of death. So 10 lakh, is it exemption per year? Suppose somebody dies today and by March 22, some 10 lakhs is received. By March 23, another 10 lakhs is received within 12 months period. So will I be able to get 20 lakhs as exemption? Because the law talks about 10 lakhs limit and that limit obviously is per year. Answer could be yes, technical reading, because 10 lakhs is not with relation to the death event, but in relation to the year itself. So one possible way of looking at things would be 10 lakhs could be per year. If you receive in 12 months time, spread over 2 years, you will get possibly 20 lakhs exemption. One. Another way of looking at things would be, it says received by a member of the family. So his spouse and children are there. They all get 10 lakhs each. 4 members are there. No, not 3. They can't be 4 members. They can only be 3 members, because when I read the definition of 10.5, children 2 are only family members. Third will not be a family member. If you have 3 children, third is not a family member. Only 2. What happens? We are twins by the second birth. There's a situation provided for. So 3 members, 30 lakhs at least you can get to say 10 lakhs each per member concerned. You'll be able to claim an exemption under 56(2)(10). This is the way you're looking at law now to bail out somebody else to say he genuinely deserves some sympathy. He genuinely deserves an exemption. Significant expenditure is incurred by him. Therefore, he deserves an exemption. You're possibly looking at a contorted way of looking at law to grant him an exemption, which otherwise should have been naturally and logically been available to him. This will be the first portion. Then over to Chythanya back again. Yeah, please. I thought I'll not have questions because we're already running late. Please, one question only. Yeah? No. It's important that there are more important portions to be dealt with. I know the question therefore is I don't know the answer, therefore I'm preventing it.
Sir,
Before the question comes, I don't know the answers.
This is relating to COVID.
I thought you made a statement there like that.
Sir, I'll go back to section 17, where deduction has been given for COVID-related treatment specifically, as per the guidelines to be prescribed by central government. But that section has a retrospective applicability from financial year 1920. Now we are in financial year 21-22. If they prescribe some guidelines now, what happens to the expenditure incurred for the last 3 years? Can I take a 37(1) deduction, or can I say that these guidelines, whatever they are going to prescribe, will be read to be prospective? Therefore, I will not be able to meet that condition. Therefore, in spite of not meeting those conditions, I'll still be eligible. 2
things were asked. The question is from 2 points of view. From the employer's point of view, those guidelines not relevant. It's only for the purpose of taxation in the hands of an employee. Those guidelines will be relevant because amendment is section 17. So from an employer's point of view, if it is for the purpose of employee, it will be allowed as a deduction. Second, from the point of view of the employee, question therefore you're asking is, guidelines are coming today. And possibly when I incurred the expenditure, I got the benefit concerned. I may be in tune or compliance with the guidelines. I may be beyond the guidelines. Therefore, when I got the money, essentially as a relief from COVID measure, then would I be entitled to the exemption at all? When we were discussing this, we were looking at a situation where today, actually a person is dying because of COVID, not reporting elsewhere. The recordings are therefore what Supreme Court is saying is not all deaths of COVID are being correctly recorded. They have given directions to the government concerned. Don't look at all these technicalities. Please start providing relief. That's a sentiment we will have to therefore go about, because if you're having an evidence to say that you had a COVID-related test, RT-PCR test, or some other treatment which indicates that your prescriptions are in relation to those diseases associated with COVID concern, In my opinion, that should be adequate enough for us to make a statement that I had suffered from COVID or related diseases, and therefore I fulfilled the commitment that the government made in Parliament in June 2021. I should therefore be entitled to the benefit exemption, even though I don't technically fulfill the guideline issued by the government.
Thank you.
If it were Ambedkar or Jnana Bharat, it should have been far better because lights wouldn't have been this bright. Right? Post lunch. Now it's a smaller hall, lights right above your head, and it must be really making it difficult for you to get indoors. I could witness Vivek struggling. Poor guy is seated in the front end, like.
Problem for them is to conceal that fact.
How much ever he tried. Yes. I have polar opposite topics. In the morning, I had topic which suited MG Road, crypto. Now I am discussing 68 Chickpete topic. Yeah. Rather Calcutta topic. So you would know section 68 where any sum found credited in your books of account, you fail to give an explanation as regards to nature and source, or the explanation you furnish is not found to be satisfactory by the learned assessing officer because the needful has not been done. In fact, in one of the judgments, it is written that no needful has been done before the AO or before us. Actually, what was meant was that proper explanation was not given. But somehow, the ink flew off the pen to make this statement. Anyway, court said that the genuineness, identity, and creditworthiness, particularly when you say the money has come from ABCD, if the assessee is able to establish these two factors, that the transaction is genuine, I would identify from whom the money has come, and his creditworthiness. That should be good enough. If I were to borrow from Narendra, what is his creditworthiness? See, I were to get about 10 lakhs from him. Narendra is a man of means. So 10 lakhs, if you would give to me as a loan, by reason of his standing in the society, one should be able to say, yes, he could have given 10 lakhs. If I were to upgrade it to 10 crores, the question might possibly arise, although he may essentially be in a position to do it. 10 crores, yes. 20 crores, then, you will start raising eyebrows. That is when the creditworthiness could be a point of question. This is mistaken by department as source of source. If I were to get 10 lakh from Narendra and Narendra standing, confirms to it, then department cannot ask from where did Narendra get 10 lakh? That is none of the business of department. That will amount to me establishing not my source, the source of my source. It's called SOS. Now, when court started saying that you can't embark on an inquiry on SOS, in 2012, they brought in a proviso to say that in the case of receipt of any application money, share application money, share capital, share premium by an unlisted company in which public are not substantially interested, from a resident, then it shall be deemed that the assessing office is not satisfied with your explanation as regards the nature and source unless the person to whose in whose name the sum is found credited in your books of account would explain to the satisfaction of the AO, needful will have to be done twice over. From my end, not enough. Narendra then will have to go and explain the nature and source of the money. This is called establishing source of source, which was statutorily imposed by Finance Act of 2012 insofar as receipt of share capital, share premium, and share application money is concerned. Not in all cases, only from a resident, only by an unlisted company, only in these three streams. Now they find that, oh, this is confined only to share capital, share premium, and the share application money. Department is finding problems even in respect of loan or borrowal. So the memorandum says that you are masquerading your unaccounted money through loan or borrowal. Courts are holding that because you are able to establish genuineness, creditworthiness, bona fide, no decision can be made. We are helpless, so we're bringing in another amendment. So what they have done, the existing proviso dealt with the share capital is now relegated as second proviso. They have introduced another proviso, which now comes as a first proviso, which will say that where the sum so credited in the books of account, the sum so credited consists of loan or borrowing or any such amount by whatever name called. Look at this. Loan or borrowing or any such amount by whatever name called. Any explanation offered by such assessee shall be deemed to be not satisfactory unless the person in whose name such credit is recorded in the books of such assessee also offers an explanation about the nature and source of such sum so credited. Such explanation, the opinion of the assessing officer aforesaid, has been found to be satisfactory. So whatever is required for the share capital is now brought in even to loan or borrowal or any such amount by whatever name called. If you look at the memorandum, it clearly confines the role of this particular proviso only to loan or borrowal. If you look at the text of the proposed proviso, it says loan or borrowing or any such amount by whatever name called. So now we have this concept of aegistem generis, loan or borrowing, or they have not said any amount by whatever name called. They have said any such amount by whatever name called. That such cannot come out of blue. It has to have reference to an item which is mentioned in the preceding paragraphs or whatever, preceding sentence of the preceding words, whatever. Therefore, such amount will have to be necessarily construed as being in the nature of loan or borrowing. So Mr. Padam was mentioning about MM Aqua principle. Justice Nariman said that the debenture cannot be called as loan or borrowal. And therefore, they made an amendment not clarifying that loan includes debenture, loan and debenture, they have said. So statutorily now it recognized that the debenture is not the same as loan, as they clarified in the context of 43B3C. Now, if you have to apply that principle here, could we say that this proviso would not apply to debenture? Because loan, borrowal are such other amount, any such amount by whatever name called. This is too aggressive a point of view. Don't play too much with it. You're aware of implication of 115 BBE, where the tax is as high as 60%, surcharge of 25%, and the cess taking it to close to 80%, and CO motor addition, no penalty, addition by AO, 10% penalty, addition by O in the course of such 20% penalty, which will take it to beyond 100%. So be careful about it. Don't play very aggressively thinking that the debenture may not come here. You'll have to be extremely conservative when you plan your affairs in the context of section 68. And moreover, you'll have to do the needful at least twice, as I said earlier. So keeping all this in mind, you'll have to plan your 68 aspect. Now, if you go here, a few more aspects will have to be seen. In the context of loan or deposit, two Bombay High Court decisions have said that the SOS cannot be asked to be proved. So essentially, this particular amendment would overcome two decisions, Vidita Towers and Gaurav Triyogi Singh. These are the two decisions which are under now. let's look at the scope of this as to where this provision would apply. 68 would apply whenever any sum found credited in your books of account, whether or not you had borrowed that money from somebody else. It is not that it will apply only to loan. You claim some agri income, they disbelieve it, an addition is made, would also be under section 68. Demonetization deposits, you would attribute it as relating to sales, like in many jewelers cases, midnight deposits had taken place. Explanation was given to the effect that all this towards the huge rush of sales thanks to demonetization. They disbelieve it, it could be a case of 68. But these are the cases where you wouldn't have credited anyone's name in your books of account. So the extra burden of having him to prove the SOS would not arise here, because it is not in the nature of loan or borrowal of any money or such amount by whatever name called. This is where such amount by whatever name called would matter. I take some gift, they doubt it. Then also they cannot invoke it, because if I get a gift from Narendra, I will not be crediting his account in my books of account because it is a gift. So I will directly take it to my capital. I wouldn't create a liability in his favor. So the proviso should not apply in such case. Now, earlier they had kept share capital and share application money along with share premium. This would apply in a limited case where you are an unlisted company and you get share application money from a resident, then only you will be troubled. Now that you have loan or borrowal or any such amount by whatever name called, the question that arises, this Prashant asked this question in the course of discussion. The question that arose was, should share application money now be treated as loan? See, the difficulty with the new proviso is it applies to all cases, not restricted only to unlisted companies. Unlike in the case of share capital, which would have troubled only unlisted company, the two receipt from a resident, this proviso would apply in omnibus situation. It applies to all assessees, listed, unlisted, government companies, whatever. It would apply to the loans or borrowals or such amount by whatever name called taken from any person, resident, non-resident. Only exception is venture capital undertaking or venture capital fund. You take it from a bank, they can question you now. NBFCs, they can question. Cooperative societies, they can question. All loans borrowed, the lender will have to come and tell the AO that this is the source of this funding to you. Look at the reach they would want to have. And any little bit of amiss from your side in explaining this would mean 80% tax. So now the share application money which I was discussing, as it would appear in the second proviso dealing with the share capital put as part of that, in my understanding, share application money should not be relegated or upgraded to be called as loan or borrowal. It would not fit into the family of loan or borrowal. It is rather money given not in the nature of loan or borrowal for the purpose of an investment, and if shares are allotted, it will only get appropriated. This cannot be called as loan or borrowal. As I said earlier, it will apply to now all borrowal from banks, financial institutions, NBFCs, listed companies. That's about 68. Any questions? And No, if you want to use MM Aqua decision and the subsequent amendment to 43B, you would possibly exclude debenture, but please do it as a defense, not as a plan. Yes. They can do, yeah. They can even ask the central government if you borrow money from central government. Bank is taking deposits, right? Yeah. It will apply to bank also. Yes. So, see, for the loan which you have to take a case of FD, You have taken loan on FD. Insofar as your loan is concerned, bank has to come. Insofar as FD is concerned, you have to go.
Loan given to the bank,
That's what I said.
deposit to the bank, asking.
Exactly.
Received by bank.
Received by the bank.
Yeah.
Received by the bank from somebody.
That's what I've said. In an
Practically,
FD,
no.
bank has received it from me.
Theoretically, yes.
Somebody else is another thing. That's it.
But one basic problem is that unfortunately, So that section 68 is not being invoked in the hands of the banks and the financial institutions. But in the case of cooperative society, they have started doing it. Especially after the demonetization period, now we are seeing assessment orders where the cooperative society is asked to explain the source of the deposit notice.
Yes. No, answer is very simple. They can ask anyone and everyone. Yes, sir. Yes, please tell me.
They receive the money in year 1 and they decide to allot shares in year 5 or year 6. So until then, they won't have filed this return of deposits also. Suddenly, when they decide to do an allotment and all those procedures, in terms of passing special resolution, board resolution, etc., then they have to be shown as a loan only, no, sir. It cannot be definitely shown as a.
See, I was only trying to say that the share application money collected by an unlisted company from a resident is put in the category of share capital, share premium, share application money already. This is already put in a proviso. Now a separate proviso is brought in for loan or borrower or such amount by whatever name called. So as the parliament brought in the new proviso, they are aware of the existing proviso which dealt with a particular family. So it's quite not unreasonable for us to understand that the parliament did not want to touch these three areas which are already addressed in a particular manner. This is a method of interpretation. Yes. Now you may see, we may debate on it, like how we know the debate takes place. But my understanding of law is that if they've already categorized as one family by virtue of proviso in 2012, after about 10 years, they're bringing another proviso, wherein they are calling it as loan, borrower, or such amount by whatever name called. The word such will have to be understood as loan or borrower. I am agreeable with his general understanding that till such time the shares are allotted, share application money may have to be treated as loan, because if share is not allotted, they'll have to return it with interest. I'm aware of that. But thing is, in this particular setting, we'll have to do an interpretation. In this scheme of things, the interpretation that is possible is share application money having already been dealt with by a particular proviso, where it is restrictedly made applicable only to what is collected from a resident by an unlisted company. Then you will be significantly diluting it if you put it in the family of loan or borrower law, such amount by whatever name called. Yes. Now, that's what, that if you don't accept my interpretation, it will get covered. Otherwise, it will not get covered. See, what SRS is saying is a listed company will now take share application money, which is specifically excluded by virtue of the existing proviso since 2012. So now my interpretation is accepted, it would not trouble the listed company. If my interpretation is not accepted, then even a listed company now accepting share application money will have to do it. Yes. See, it's all section 68. For anyone to invoke section 68 in the relevant financial year, there has to be a sum found credited. Yes, sir. Any more questions? Now let's go to section 79. See, 79 would not much be applicable for all of us. It is essentially an Air India amendment. So, Air India had to be sold to Tata's. Air India has huge losses. One of the negotiating points could be that the loss of Air India should remain preserved. It should not lapse. By reason of central government disinvesting in Air India would have meant non-compliance with the mandatory common shareholding requirement of section 79, which says that minimum 51% shareholding carrying not less than 15% voting right, minimum will have to be preserved. At the end of the year in which the loss is suffered, and at the end of the year in which the losses ought to be set off. Between these 2 points in time, the same shareholders who held shares carrying not less than 51% of voting rights would be the shareholders would be holding shares carrying not less than 51% of the voting power in the year in which it is sought to be set off. But then in the case of Air India, what would happen is shareholding will change beyond 51%. Thousands of crores of loss, which it happily accumulated all along, will lapse. So now that is why they have brought in section 79. In 79, subsection 2, clause F has been introduced to relax this condition, provided the ultimate holding company by itself or through its subsidiaries will hold at least 51% of the voting power in the erstwhile public sector, which has now become a private sector company. So it's essential for Tatas, either the immediate holding company of Air India or the ultimate holding company or anywhere in this, upper tier companies. In the aggregate, they shall be holding at least 51% of the voting power in Air India. As long as they hold it, Air India will be eligible to, if at all, if and when it makes profit, it will be eligible to set off the brought forward loss. This anyway would not trouble unabsorbed depreciation, because this is coming in chapter 6. It applies only to the brought forward business loss. In whichever year, the shareholding or voting power of 51% is not preserved. Let us say Air India is having about 1,000 crores of loss on a very optimistic basis, and Air India would run for about 4 years, and about 300 crores of loss would be offset on the basis of profits made in first 4 years. 51% is preserved. In the 5th year, 15% is not preserved. Let's say Tata's would sell it off to somebody else, Singapore Airlines, assuming Government of India would permit them to sell so. Then in the 5th year, balance 700 crores of loss, which still remains non-set off, would lapse. But nothing would happen to the 300 crores of loss, which already stood set off in the first 3 years. So whatever during your continuance of compliance of these conditions, whatever is set off will not be disturbed. The moment the 51% is diluted, from that year and subsequent previous year onwards, you will not get the benefit of carry forward in respect of those past losses. Now let's go to any questions. See, there are some highly technical issues which I will not get in about this condition F and the basic condition under 79(1). This is an important section. The department found that during such survey, there will be undisclosed income detected. In fact, they'll coerce people to come with some declaration, despite the board circular saying that you should not extract confessions, you should rather concentrate on evidence. But then they exactly do the reverse, and they'll get your statements. Many a times you would advise your clients, oh, there is some loss brought forward, there is some depreciation brought forward. Anyway, you have to get rid of them. You offer some 5 crores. We will anyway use it to offset the losses that were carried forward. So department will be expecting bonanza payment on these 5 crores which you offered to tax, eventually to hear that you want it to be set off against your brought forward loss. So they'll be very deeply disappointed. So not to have any further disappointments, they have brought in section 79A, which essentially says that notwithstanding anything contained in this act, which according to SRS, not understanding anything contained in the Income Tax Act, where consequent to a search under section 132 or a requisition under 132A, even a survey under 133A barring TDS survey. See, survey will be of various types: the regular survey, TDS survey, expenditure survey. So TDS survey is excluded. Your expenditure survey, regular survey, the total income of any previous year of an assessee includes any undisclosed income. No set off against such undisclosed income of any loss whether brought forward or otherwise, or unabsorbed depreciation under section 32(2) shall be allowed to the assessee under any provision of this act in computing his total income for such previous year. There is a survey, there is a search, there is a requisition. Consequent to that, there is a assessment in your total income, which includes undisclosed income. So what is undisclosed income? We'll come to later on. You may yourself suo motu offer this undisclosed income in your return, or department may add. End of the day, your total income will include undisclosed income, which comes as a consequence of search or survey. Then such undisclosed income cannot be set off against any loss, whether brought forward or otherwise, meaning current year loss or brought forward loss. And also it could not be set off against unabsorbed depreciation under section 32(2). No set off of current loss, no set off of brought forward loss, and no set off of brought forward depreciation. Nothing would be allowed. Now, what is the meaning of undisclosed income? If you look at 271AB explanation, the undisclosed income which is given there is almost the same as the undisclosed income that is stated as an explanation under 79A. What it says is any income of the previous year represented either wholly or partly by any money, bullion, jewelry, other valuable article or thing, or an entry in the books of account or other documents or transactions found in the course of such requisition survey, which has not been recorded on or before the date of search, on or before the date of survey, or has not been disclosed to the commissioner, the principal commissioner, the chief commissioner, the principal chief commissioner, before the date of search or requisition or survey, as the case may be. And not only that, any income of the previous year which represents an expenditure recorded in your books of account in the normal course of your business, and that entry is found to be false, and it would not have been found to be false had the search, survey or requisition not taken place. Many times what will happen is when they carry out a search in you, they will find you to be in possession of money, bullion, jewelry, valuable article or thing. Then you are not able to explain that. It is not recorded in your books of account on or before the date of search, nor have you ever informed the principal commissioner before the date of search. We actually struggle to find out under what circumstances will an assessee before the date of search go to the principal commissioner, fold his hands, and this is my undisclosed income. I don't know. I do not know why have they done it. Anyway, if any one of you in your remotest possibility had encountered this kind of a situation, you can enlighten us in that regard. Now, which you had not recorded in the books of account on or before the date of such seizure or whatever, this would be called as undisclosed income. That apart, they will have found that your books of expenditure, which expenditure is bogus. For example, they come to my premises, they will find that I booked the labor of 10 crores. They have found some slips to say that out of this 10 crores, about 3 crores is booked in respect of the bribe which I had to pay. So many times what will happen is there are going to be illegal gratifications which will have to be necessarily done in the ordinary course of conduct of business that needs to be done. And I cannot book it as bribe because Mr. Padam explained explanation 1 and explanation 3 under section 37(1). And therefore, I would have just booked it as labor charges. But in some slip, I would written government officials 10%. GO 10, I would have written. So then they will estimate it and say that no, your labor expenditure ought not to have been 10 crores, it should only be 7 crores. That means to the extent of 3 crores, my entry is found to be false, and it wouldn't have been found to be false had the search not taken place. The 3 crores also would be deemed to be undisclosed income. Against this undisclosed income, set-off would not be allowed. This is how it works. And a few things would be allowed. Expenditure would be allowed against undisclosed income. There is no difficulty. Only set-off of loss, current loss, brought forward loss, and depreciation would not be allowed. Expenditure would be allowed. Current allowance would be allowed. Current allowance means current depreciation would be allowed. Brought forward allowances other than 32(2) would be allowed, like scientific research capital expenditure brought forward, family planning capital expenditure brought forward in 3619. Those things would be allowed. Chapter 6A would be allowed. And benefit of deduction of enhanced closing stock, which will then translate into opening stock for next year, those are not barred. See, sometimes during the course of search, they will cajole you to offer some GP, like you offer some 2% of GP, 3% of GP, etc., and they'll force you to offer it to tax. So when GP addition is made, it may not necessarily fit into meaning of undisclosed income, because there cannot be an entry which is found to be false. It cannot be said that there's a document to establish it. It is not to be said that it is represented by money, bullion, jewelry, other valuable article, I think, found to be in your possession at the time of search. It is just a matter of GP addition, which to somehow get rid of the search party from your premises, you would have conceded. That would not get hit by this particular provision. Then we will go to section 80CCD. Any questions? 80CCD, some couple of small amendments I'll take you through. Central government employee would have enjoyed the exemption up to 14% of government contribution. See, normally the new pension scheme, what would happen is employer contribution will first be deemed to be a income under section 17(1) read with 15. Then it will be neutralized by 80CCD subsection 2 deduction. But then for the private employment, it is 10%. Where an employer will contribute more than 10%, say 15% will contribute, 15% will be treated as your salary, but how much will be allowed as a deduction? Only 10%. So incremental 5% would have still sat as part of your salary income on which you will have to pay tax. So to incentivize, they enhanced the central government contribution to 14% as against the private employer. Whereas the state government employees were, not treated at par with central government employees. They amended to say that even state government also can contribute not just 10, but they can go up to 14%. And on that 14% contribution, you don't have to pay tax because it will get neutralized by 80CCD 2 deductions. Now in 80DD, 80DD is a deduction which you get if you have a handicapped dependent in respect of whom you would incur expenditure for his treatment. Ordinarily, if he is handicapped, you'll get 75,000 rupees as a deduction under 80DD for expenditure you would incur for his treatment. If he is suffering from severe handicap, you get 1.25 lakh as a deduction. This is in respect of expenditure you would incur for his medical treatment. But then there is one more deduction that is available, or one more outgoing that will also qualify for 80DDs. Instead of incurring expenditure or along with incurring expenditure, you may want to secure his life post you. So you may buy an annuity scheme or buy any scheme whereby it would provide for payment of annuity to handicapped dependent post you. After you, somebody has to support. So you create a fund. You buy out a policy from a life insurer like LIC or whatever, whereby after you, it will be paid to the handicapped dependent. The law provided that if the handicapped dependent predeceases you, that means as you still survive, he dies, obviously the money that is kept would be paid back to you and you would have ended up paying tax. So there's no change on this. But then the earlier law created a problem. If you were to have a handicapped dependent, he couldn't be paid annuity till you kick the bucket. If you live up to 90 years, he may be 70 years, but he can't get the annuity. Because the scheme provides, the section provides that annuity could be paid only when the person who contributed leaves this world. Now that was creating a problem, because after some time, even the taxpayer may not be in a position to support. He would have created fund. The fund is lying with LIC. Now I am not able to support. and they can't pay to the handicap dependent till I die. So this was becoming a nonsense. They amended 80DD to provide that the LIC need not wait till I die to pay the annuity to handicap dependent. As long as I hit the age of 65 and I stop making contribution to the fund, then annuity could start. Annuity need not wait till I die. So this is the amendment they have carried out under section 80DD. Then in 80 IAC, eligible startup, you will have a tax holiday of 10 years in a float of 15 years, 10 consecutive years in a float of 15 years. There was a condition that the startup ought to have commenced manufacture by 31st March of 2022. The memorandum recognizes that thanks to COVID, you may not have been in a position to commence a manufacture. They have given you another year of time to do so. 80 LA is amended. In the morning, I mentioned to you that in an international financial service center, a leasing company which would lease out the aircrafts, would also qualify for 80 LA deduction. A unit in an IFSC which would be leasing the aircraft, many a times it may have to sell those aircrafts which are previously leased because it may become outdated. Its customers may not want it that way. The model would have become changed. Then they will want to sell it. If on sale they make a profit, that profit would be exempt in terms of 80 LA. So that benefit is now extended to ship also. So if a unit in an IFSC, which is in the business of leasing ships and posts lease for a certain period, the ship is sold to somebody else and a profit is made, on such profit, the unit in the IFSC will get the tax holiday under section 80 LA. 92 CA will deal with transfer pricing provisions. TPO 92 CA 9, they've extended the period from 2022 to 24 in respect of phaseless TPA, which anyway is not a very material amendment as far as this year is concerned. You would know a little later when Mr. Padam explains 144B, how the TPO is made part of the technical unit in the regime of phaseless assessment. Now let's go to section 94. See, 94 is an important section. Yes. Section 94 deals with bond washing transactions, which will deal with various situations. Let me not get into all those situations, except two which could be of matter of concern to us. 94.7 deals with dividend stripping. 94.7 deals with bonus stripping. What is dividend stripping? You buy a unit or a security pre-dividend. Obviously, you'll be paying a marginally higher price. Get the dividend, which at some point in time would be exempt. Then post-dividend, sell it. Obviously, you would be selling at a price less than the price at which you had bought. So you cut an artificial capital loss, or at least conceived to be artificial by the department. If the dividend is exempt, the capital loss which you booked to the extent of dividend would be ignored. This is what is known as dividend stripping provisions, covered by 94.7. It applies to both dividend stripping in case of share, dividend stripping in case of units. Only the difference being that the window would vary. If it is share, there is a record date. You ought to have bought within 3 months preceding the record date and ought to have sold within 3 months succeeding the record date. If it were a unit of a mutual fund, you ought to have bought within 3 months preceding the record date, but you ought to have sold within 9 months succeeding the record date. This is the window. But for the change in window, otherwise the provisions just remain the same. Right? This is 94.7. 94.8. deals with bonus stripping. And so far, it applied only to units. It did not apply to securities. Securities is defined as including stocks and shares. And it would not include units. So 94.8 as it stands today before the proposed amendment applied only to units. If you were to buy the units come bonus at a higher price, get the bonus, post bonus you junk it, create a loss, loss would be ignored, but the loss so ignored shall be deemed to be cost of bonus shares or bonus units. Otherwise, if you get units free of cost as bonus, cost will be deemed to be nil in terms of section 55. I'll repeat again. You buy units come bonus, say at 120 rupees. You get bonus units. 100 units you buy, you get about 10 units as bonus units, 110. You had bought it, say, for 1,000 rupees. And post bonus, you sell it at 800 rupees. So you would have cut a loss of 200 rupees. You got a bonus of 10 units. So 200 rupees loss will be ignored. It would not be allowed to be set off against any other capital gain. But the loss so ignored of 200 rupees, that will be imputed as cost of these 10 bonus units. Have you been able to understand this? Now, they've extended this to securities as well. Hitherto it was applicable only to units. Now they've extended to securities as well. That apart, they have carried out some amendments wherein they expanded the meaning of units, which would then trouble you not only in the context of 94.8, which will also create some issue in the context of 94.7, because 94.7, which will deal with dividend stripping, applies both to units and securities. 94.8 hitherto applied only to units, now extended to securities. But the alteration of meaning of units, which possibly could have fit in as securities, now will translate to become units. When you move to 94.7, the window applicability would vary. So that is one consequential change that could happen, which we'll have to notice. But the 94.7 would apply only if the income is exempt. Nowadays, it is not exempt. So therefore, it may really not matter much. But in a given situation of, in a future situation where they will exempt it, well, 94.7 will bounce back to action, then you'll have this difficulty coming in. See, what will unit mean now? Unit shall mean now a unit of a business trust, a unit defined under 115 ABB, that is under 1023D, typical mutual fund. Then the units in alternative investment fund, AIF 1, 2, 3, whatever units you have. The units in, like real estate, InvIT and REIT, all are now regarded as units. If you go to the meaning of Securities Contract Act, these are also called as securities. So now a doubt would arise as to whether these are units or these are securities. And it would make a difference for the differential window you have in 94.7, which I was trying to explain a little ago. Consequential amendment has been made to record date, which may not be much of a yes. Now with this, we have two more small sections. 115 BAB is amended. You have this 15% tax on profit from manufacturing in some cases, where the cutoff date was 31st March of 2023. They've given you an extended period of another year for that. Another important amendment is 115 BBD, where like you have held minimum 26% stake in a foreign company and you get dividend. To encourage you to have the dividend repatriated to India, they had reduced the rate of tax to only 15%. At the time when the dividend is otherwise exempt, thanks to 115 vote during those days, domestic dividend was exempt. Foreign dividend, people are not getting it to India at all. Because I'm a company in India, I have a subsidiary in Sri Lanka. I would never make my subsidiary in Sri Lanka declare dividend. I'll keep the money in Sri Lanka only. So India wanted the money to come back to India to encourage, the multinational company based out in India to get this money back to India. They have reduced the rate to 15%. Now they have said there is no parity. Domestic dividend you pay higher tax. Foreign dividend you can't be allowed to pay lower tax of 15%, and hence they have, made this section inapplicable going forward. So foreign dividend, when you get it from specified foreign company, would now no longer be eligible for concessional rate of tax. So now we'll break for tea. No concession.
Or only temporary, and it will soon be filled. There is a lot of gaps in what we say, what they understand. But I'm looking at the physical gap. Nice social distancing is happening now at the moment. Continuing with some of the smaller and not much of a consequential amendments which may not require much discussion. Section 115 JVC, which deals with alternate minimum tax, has been amended to say that in the case of a cooperative society which is liable to pay tax under Section 115 JC, the general rate of tax, which is 18.5%, has been reduced to 15%, and this will be applicable from the current assessment year 2022-23 onwards. So then similarly, the consequential amendments have been made in Section 115 JF, which deals with the interest payable on, which deals with the definition of the alternate minimum tax, where they refer to the rate of tax also. Say in the case of a cooperative society, they said they are making a specific clause 1A, to say that it will be rate of 15%. So definition of AMC also, in the case of a cooperative society, it is 15%. In the case of those international financial centers established in various approved cities like Gift City, or 9%, and other assessees or 18.5%. The next, a minor amendment, is with reference to the powers of the board under Section 119 of the Act. As you know that under Section 119, the board can relax the rigors of the various sections mentioned therein, and now they have included 234F. That means if there is a delay in filing your return, and if a penalty, if the late fee is to be paid, the board has got powers to relax the rigors of Section 234F and either reduce the amount of late fee payable or waive the amount altogether as it deems fit. Then Section 132, subsection 8 of the 132 says that the authorized officer can retain the books of accounts only for a period of 6 months after the completion of the assessment under Section 153, etc. Then the books have to be returned to the assessee. So now, as Mr. Padam will be explaining later, and even last year itself, we know that the entire provisions regarding reassessment, including a search assessment, have been recast, and section 147, 148, 148A have been introduced. And it has also been specifically provided that the provisions of section 153A would not apply in case of a search completed on or after, initiated on or after 1/4/2021. So what happens is that because earlier all the search assessments were done under section 153A, section 132 in various places were referring to where an assessment, they always used to say an assessment under section 153A of the Act. But because of the amendment made to 153A, which is not applicable in respect of a search commencing on or after 1/4/2021, and the amendment also made in section 147, 148, etc. Now they have said that either under section 153A or an assessment or reassessment or recomputation, which are the types of assessments mentioned or recomputation mentioned in section 147 and 148, etc. So therefore, there is another consequential amendment to section 132. 132B deals with the retention of the seized assets and application of the various assets to the demands. So if any amount is retained or if any balance is there after application to all the existing liabilities and the liabilities created under the 153A assessment, the balance has to be refunded to the assessee. And if the refund is not made within a particular time, they have to pay interest also on that amount. Here also the reference was always to section 153A because the such assessments were necessarily made under 153A. So now they have made a similar amendments like assessment, reassessment under recomputation. This is also a consequential amendment due to the amendment made to section 153A, 147, etc. Then we'll come to a very important topic, which is the filing of the updated returns. You are aware that normally an assessee having income chargeable to tax or a company or a firm must necessarily file their returns on or before the due date. And due date is mentioned in section 139(1) for various classes of assessees. After filing the return, you can file a revised return under section 139(5). Or if you have failed to file the return within time allowed under section 139(1), you can file a belated return under 139(4). And the window for filing these returns are very small. It is hardly about 3 months prior to the end of the assessment year. So therefore, for the assessment year 22-23, you have to file your 139(4) return in December 23, or you have to file your 139(5) return also before December 23, which was earlier nearly 2 years from end of the assessment year. Now it is being progressively reduced. In fact, in the memorandum explaining the provisions of the updated return, it is recognized that this window of just 3 months prior to the end of the assessment year is inadequate. Because in a given case, like a transfer pricing case where you file your return by 30th November, the window available to you for filing a revised return is only 1 month. Window available to you for filing a belated return is just 1 month, which is hardly sufficient to do that. So though they recognize this particular difficulty for the assessees, they don't touch section 139(4) or 139(5). They introduce a new section dealing with the concept of updated returns. Section 139(8) capital A is the one which deals with that. Then you have section 140 capital B, which deals with how much tax is to pay, what is the additional tax payable, and when do you pay it. Then there are constitutional amendments to section 234, 234B, etc. because of the introduction of section 139A dealing with updated returns. What does this section say? Section 8A is the enabling provision for you to file an updated return. It says any person, whether or not he has furnished a return under subsection 1 or subsection 4 or subsection 5 for an assessment year, hereinafter referred to as a relevant assessment year, may furnish an updated return of his income or the income of any other person in respect of which he is assessable under this act for the previous year relevant to such assessment year in the prescribed form verified in the prescribed. These almost the wordings are similar to what is used in section 139(1). The important point to note here is the import of the opening portion of section 139A. Opening portion of 139A says any person, whether or not he has furnished a return under subsection 1, 4 or 5 of section 139. As we saw, 139(1) is a regular return, 139(4) is a belated return, 139(5) is a revised return. But the Income Tax Act contemplates filing of returns under other sections than these three sections, subsections. You can file a loss return under section 139(3). You are bound to file a return when the assessing officer issues a notice under section 142(1) asking you to file the return. Now, therefore, the first question that would be asked is that if a person has filed the return in response to a notice under section 142(1), or if a person has filed the return of loss under section 139(3), whether he is coming under section 8A. The answer to this question depends on the interpretation of whether or not he has furnished a return under subsection 1, subsection 4, or subsection 5 of 39(5). One view is that ask yourself a question. What does it say? Whether or not he has filed a return under 139(1), 139(4), 139(5). It doesn't matter whether he has filed the return on these sections or not, or it doesn't matter that he has filed the return under some other sections also. The only question is that whether or not he has filed. He has not done so. In a case where he has not filed the return, it doesn't matter, because the section itself recognizes even if you don't file a return under 139(1), 139(4) or 5, you can file an updated return. So just because you have filed a return under section 142 or under section 139(3), why you should be denied the benefit of filing an updated return? This is one view. The other view is that section 139(8)A specifically refers to 139(1), 4 and 5. So when it refers to this one, the law envisages that only those people who are required to file the return on those and have not filed it or filed it, then they will begin. If anybody has filed a return under 142(1), they don't come under this section. We will also see that when we go up to section 140B as to what will be the impact if both the interpretations are seen with the interplay with section 140B. So for the moment, let us keep in mind that there can be an interpretation issue on 139(8)A to see whether a person who has filed the return under section 142(1) or under 139(3) is entitled to file an updated return. Just keep this in mind. And I also explained briefly what are the two different views which are possible on this. And we will take a view based on our best understanding of the law on this point. Okay. Next, there is a proviso. This proviso, the first proviso which talks about this one, is a prohibition of certain types of return being filed as an updated return. Please note that this is with reference to the types of the returns. It has nothing to do with the person who is required to file the updated return. What type of returns you cannot file? under section 139A, a return of loss. So under section 139A, you can't claim a loss return. You can't file a loss return. So this is one way of saying this. The second one is, it has the effect of decreasing the total tax liability determined on the basis of the return furnished under subsection 1. So here what happens, let us assume that even that you file a return under 139.80, an updated return, and you claim certain TDS credits or other credits which you are entitled to, which you are not claimed and which are not related to any income disclosed in the updated, extra income disclosed in the updated return, okay, then that is not permissible. So you cannot reduce your total tax liability by filing an updated return. And the next one is the return results in a refund or increases the refund already claimed in the original return filed. Then these type of returns cannot be filed by any person under 139.80. Yes.
Under normal computation. Now, subsequently, insofar as the MAT computation is concerned, I increase some profit and then I filed my updated return, which consequently results in MAT liability. Now, is that situation also covered here? And also, like, consequently, what would happen is, will I be entitled to MAT credit also?
See, the
Because,
point
like,
is,
it increases that it has the effect of whether at all, can you at all say that it has the.
what you are saying is that in the updated return, what is the change you have made? Increase the MAT profit, but compared with the original other income computed and other provisions of the Act, what is the effect of that? Which is higher, even in the updated return? Okay. So therefore, you are paying extra tax. Is the tax not only computation, the tax payable on the increased book profits, the tax payable more than the tax payable determined on the total regular provisions. Okay, so that is the additional income, because under section 115 JB, whatever is the book profits, they are deemed to be the total income. So you have filed, your section 180A applies to any person. It is not restricted only to individuals or HUF or anything. Even a company can file that. So prima facie, I don't see any difficulty in a company filing it and then claiming, but they have to pay the additional tax on that. They pay additional tax and the MAT credit should be available, because there is nothing in section 115 JA or JB, etc., which is assuming they are not taking the benefit of section 115, whatever those companies, lesser rate of tax, nor where the MAT provision is not available. Subject to that, yes, there should not be any problem on that. You answer.
See, the only criteria is it cannot have the effect of decreasing the total tax liability. The other aspect, if you have MAT credit of which you will get the benefit in the subsequent years, is not a taboo at all. As long as your updated return has not had the effect of decreasing total tax liability as compared to your prior return, good enough, you will qualify. So the MAT credit that comes to you is available to you.
Now, one of the issues is a return of loss cannot be filed. But there is nothing which says that where you have filed a return of loss earlier, to convert that return of loss into a positive income, file an updated return, and which may not attract tax liability. For instance, you are an AOP or individual or HUF. You have earlier filed a loss return of 5 lakh. Now you declare an additional income of about 6 lakhs or 6.5 lakhs. So your total income as per the updated return is 1.5 lakh. On 1.5 lakhs, you don't have to pay any tax on this. You can file an updated return on this under this situation also, because though you don't pay any tax, you get the benefit of the fact that it has been disclosed in the return. So in a given case, it will help you later in your explaining the source for a particular investment or whatever is that. And therefore, according to me, you can't file a updated return which shows a loss. But an updated return showing an income less than minimum chargeable tax is permissible. Okay. No, that's what we said. That's what I said first. I said that there are two views on this. One is that section 8A, subsection 8A is confined only to where the returns are referred to in 139(1), 4 and 5, filed or not filed. If you have filed a return under 139(3) or 142(1), you are not coming under 139(8A is one view. The other alternative view is the only thing is that all it says is whether or not you have filed the returns on this, and it doesn't say, and you are also that there is nothing in the prohibition saying that it will not, you cannot update a return which is filed under 142(1) or 139(3). Okay, therefore it depends on the interpretation of that. If a broader interpretation is accepted and taking into account the purpose behind this section, there is a very likelihood that the broader interpretation would be accepted. Okay, so therefore on that basis, possibly we can say that even if I had filed a loss return earlier, I can file it now. So that is something which I already explained in the beginning. So that issue remains. Okay. Then clause C says that the updated return cannot result in a refund, or it cannot increase the refund which was earlier claimed in the return. So Prashant had a brilliant idea during our discussions. So he said, sir, we'll do very simple. I will pay more tax than what is required as per the updated return. If I have to pay only 2 lakhs tax, I will pay 5 lakhs tax, or I'll pay 3 lakhs tax. Earlier, I was entitled to some refund. So I will include that amount also and claim extra refund. And I would say that I am claiming this is not resulting in a refund. And once I had paid the tax, file the return accordingly, the assessing officer is bound to make an assessment in accordance with law. He has to determine my total income as per the act, find out what is the correct tax payable, and then give me the benefit of the taxes paid by me and refund the entire amount. He cannot refuse to do that. For instance, he cannot definitely refuse to give you the extra tax you have paid on the basis of updated. When you have to pay only 2 lakhs as per the updated, if you have paid 3 lakhs, when he makes an assessment, he has to charge you only 2 lakhs and the attendant interest and additional tax, etc. But he can't say that, no, you have paid 3 tax, so that I will take that 3 tax as income on the 3 lakhs as tax on the updated return. That he cannot do that. Since he cannot retain a portion of the amount paid as tax also, based on the Article 265 that nobody can retain the tax except in accordance with law, even the extra tax, earlier tax, which is I paid earlier extra, that also should be refunded, is one possible view on this. So, of course, this a big question mark on this. Go to Chythanya, file a writ petition in the High Court, get a direction from the judge saying that you should be allowed to file the return. He will get it for you. Yeah.
Results in a refund or increase the refund due on the basis of return furnished under subsection 1.
Okay.
When I have not filed a return only, then clause C will not apply to me.
No, that updated return results in refund. No. Updated return results in refund. See, that will apply. Okay. So these are some issues on the first proviso on the issue. Then in respect of these returns are barred. Then comes a provision which deals with barring certain persons from filing the returns. Yeah.
So before that, also in clause C, can the return result in an increase or decrease in the refund that I've claimed? Will I
No,
still
increase or decrease? Decrease, you mean?
decrease in the refund, increase in the liability, because it still results in refund. Though the refund amount has been reduced, but it still results in refund.
See, that's what I'm saying. When you have filed the return earlier, claiming X amount as refund, and in the updated return, it is point X which is claimed as refund. Now, the refund you will claim under only one circumstance, if the earlier amount has not been refunded to you. If the earlier amount is not refunded to you, you will see when you come to section 140B that amount also should be added to the payment made by you. For instance, earlier refund was 50,000 rupees. Okay, on the updated return, it is only 30,000 rupees is the refund due. And if that 50,000 has been refunded to you earlier, you have to pay the 20,000 rupees plus additional tax on that.
No, if it's not refunded, the only question I'm trying to say
So
is,
if you do that, what is the question? The question here is, the point here is earlier return, has it increased? Does it increase the earlier refund?
no, it reduces. My question is, will I be caught by those first three words? Because
No, the first three words will apply when you have not filed a return at all earlier and you claim the refund for the first time. The later portion of clause C will apply where you have filed the return earlier, claimed a refund, and the law says that you cannot increase that refund by filing an updated return. So you will be covered by the second portion, not by the first portion.
Sir, in case I file a return, in the original return, it was under normal tax liability. I claim some additional expenditures because of which my normal tax liability reduces, but I move into MAT. I pay MAT, but my tax liability under normal provisions reduces.
See, the point is simple. In this case, obviously the tax which you are going to pay in the updated return, the tax on the income return in the updated return is going to be less than tax determined in the earlier return. So you are prohibited. Because MAT tax is going to be less than, maybe less than the original tax paid. Based on the original return, normally, no, that's not it, because he has computed MAT earlier, he has computed the normal income. So where is the extra tax? No, but I am assuming that your MAT in the original return and the MAT in the updated return are same. Is it so? Are you increasing the MAT return, MAT book profit? No. Tell the facts according to you. Is it that, no, I'll ask you a question. Is it your book profits declared in the original return and the book profit declared in the updated return, are they same? Okay, if they are same.
If I may intervene, what was the tax paid by in your original return? What tax did you pay? Give me some number. Under whatever provision, normal or MAT, how much tax did you pay in the original return? Now in the updated return, what's your tax liability?
It'll be less.
No, wait. What's your tax liability?
Simple question. Arithmetic.
What's your tax liability? Is it 1200? You can. If it is 800, you can't. Simple. That's it. Doesn't matter. That is why I'm.
No, he made a very clear statement that in the normal computation, he is increasing the expenditure and thereby reducing his income. And therefore that amount cannot be more than the original return. That is why the MAT, whether you are increasing the MAT tax, and if that increase in MAT tax is more than the original tax paid, yes. Maybe arithmetically, if you just look, what is the tax paid earlier? in the updated return, if the tax payable is more than that, you are entitled, otherwise not. Okay, fine. Now we come to the last question, please. Yes, yes. See, now the point is very simple. If you don't file an updated return, you are exposing yourself to the penalties. Even if you disclose something to, forget the commissioner, you yourself write, you yourself file a return which is not an updated return. You don't say it under this. If you do, and if later on the assessing officer based on that takes action under section 147, 148, etc. No, but the problem would be this. You look at section 270A, etc. You may have certain issues on that. But the point is, you don't get the benefit of any waiver of prosecution. You don't get any benefit of this. This is a benefit according to me. So therefore, it may be a bit difficult. Okay, but it is not. You are right. It is at your option. Nobody compels you to file an updated return. So we'll come to the next one. Here the issue is that the second proviso talks about prohibited persons. The difference between the first one and the second one is that in the first one it is a type of the returns. So these prohibited persons cannot file the updated returns at all. You remember, the prohibited persons are barred from filing updated returns for the relevant years. Who are those prohibited persons? Where a search under section 132 or a requisition has been made under section 132A in the case of such person. A survey has been conducted under section 133A other than 2A, which Chythanya explained as a tedious survey. They are also barred. A notice has been issued to the effect that any money, jewelry, or valuable thing seized or requisition under one article under section 132 or 132A in the case of any other person belonging to such person. This is similar to section 153C kind of situations, which is also covered under section 148. Okay. So therefore, these persons, the searched person, and we will call the other person, the person who has not been searched, but whose documents or assets are found in the place of such persons, and on whom also the assessment under section 147 read with 148 can be made. Okay. So, and also C deals with the assets found and D deals with the documents, etc. found in the case of the other person. So for all these years, which are covered by the notice issued under section 148, read with after following all the procedures for which the notices are issued, the person is barred from filing an updated return. There are a couple of issues on this. On what date you look at because what he is prohibited from doing is, so the relevant assessment year, the year in which the search, etc. takes place, and 2 assessment years preceding such assessment years. So if a search takes place, let's say in June 2022, he cannot file an updated return for 23-24. He cannot file an updated return for 22-23 and 21-22. For these 3 years, he cannot file the updated return. So now the first question is, suppose he had already filed the updated return. On that day, there was no search. Later, after he files, the search takes place. And because of this 2 subsequent previous years, or even the same year in which the search took place, also, he is prohibited. Now, I'll give you an example. Okay. We will say the updated return filed on March 2023 for the years assessment year 21-22 and 22-23. Okay, he has filed the returns, updated returns. Then the assessment is also completed by December 2023, that is within the time allowed under section 153. Okay, assessment is completed. Search takes place on 15 January 2024. So if you look at the relevant assessment year and the two earlier years in the proviso, one is 24-25, 23-24 and 22-23. So out of this, what has happened? For 22-23 has already filed. So the question is, because a search takes place earlier and one of the years for which the updated return has been filed becomes ineligible, would it apply? So our view is that you have to look at the law as on the date of filing of the updated return. On the date of the filing of the updated return, it was valid return. And in fact, on the basis of that valid return, the assessing officer has taken action, framed the assessment also. So that being the case, there is no provision. The section 139.80 as second proviso cannot be interpreted to say that you're not. It will prohibit only if you want to file the updated return after the date of the search or after the date of survey. Now, if you look at clause C, what does it say? It says notice has been issued to the effect that any money, bullion, jewelry, article or thing seized or requisitioned in the case of any other person belongs to such person. Now, if a search takes place in my premises and a warrant is in my name, and if they find the assets or the documents belonging to Mr. Padam, nobody gives notice to Padam to say that I have found all these things in SRS search, so I want to treat it as yours. Maximum, the assessing officer having jurisdiction over him will issue a notice under section 147 or 148. That's about all. He doesn't give him a notice that I have found all these things. He may record in his Padam's file that, listen, I am doing this because this is what I found. I am satisfied these assets belong to Padamchand Khincha, not SRS. But there is no procedure for giving notice. There is no practice of giving notice. Those of us who have dealt with 153C earlier, etc., you will only find a notice is issued under 153A. He will record the satisfaction as required under 153C. Then based on that satisfaction, he will issue a notice under 153 as he filed the return. He may draw reference to 153C, but he will not tell you that I propose, so these are the documents or these are the assets which are found. And that notice also is notice asking me to file the return. Not a simple notice informing me of what satisfaction he has reached. So therefore, we found it a bit difficult in practice to say why. So one way of answering this is that since there is no such provision to give notice, this clause C is not applicable, and therefore the other person can file an updated return, subject to it not being a loss return, not increasing his tax liability, not reducing his tax liability earlier, or not claiming a refund. He is not prohibited for those 3 years, and therefore he can go ahead and file is one issue. Okay. Next. You cannot file a second updated return. Only one updated return can be filed, because if you see this, where an updated return has been furnished by him under this subsection for the relevant assessment year. So for the same assessment year, you cannot file a revised updated return. You can file only once. If your original updated return is otherwise valid, the AO will act on that basis. He may take the information contained in the second, if you have filed by mistake, and if, let us say, it has been accepted also, or the portal has allowed you to take that, which may normally not, but by any chance it has happened, he can take the information from that particular second return and make an assessment based on the updated return by adding this income also, but you will not get the other benefits. Okay. Next. Any proceeding for assessment or reassessment or recomputation or revision of income under this act is pending or has been completed for the relevant assessment year in his case. So if there is a pending proceeding for a particular assessment year, you cannot file an updated return for that. Pending proceedings or a completed proceedings. Now, completed proceeding, we understand normally it would have to be a case where an assessment order has been passed in 1433, though it has not been specifically, it only says that or an assessment has been or reassessment has been completed for the relevant assessment year in scale. But pendency is an issue. Pending proceedings, as you know that starting from the Supreme Court in Abraham's case said that an income tax proceeding commences with the filing of the return. And in the depending on the context, the assessment may include even recovery of tax. So therefore, this is a well settled principle. And in the context of section 153A, where it says that all pending assessment will abate and the assessment can happen on the basis of as if it is on the proceedings etc. can continue as if it's unabated assessment. There the courts have been saying that under what circumstances you can say an assessment is pending or not. A few things which are as per the court decisions are that if, for instance, if an intimation under section 143(1) has been issued before the date of search, then that assessment is not pending. If no notice under section 143(2) has been issued and the time limit for issuing under 143 notice has expired, if these two conditions are satisfied on the date of search, then also it is not pending. The third situation, one straight decisions of the Bombay bench of tribunal in Pratibha Industries, where they said that relying on the circular 539 or 5, which one? That 180, 1989, 549, by relying on that circular, that is, which is the circular explaining the provisions of the Finance Act 1989 or Direct Taxation Amendment 1999, said that the only thing is you have to ask is this, whether on the date of search a notice under section 143(2) has been issued. Don't even bother whether the time limit for issuing such notice has expired or not expired. If the answer to the first question is no, that no notice has been issued on under 143(2) on the date of the search, even though the time limit is still available, even then the assessment is not pending. They relied on the circular on the concept saying that if you file the return and if you don't get any notice, it is meant that your assessment is, your return is deemed to have been accepted. Okay, so therefore, one way of looking at it is that unless a notice under section 143(2) had been issued, it is not pending, proceedings are not pending, and therefore you can file an updated return. Okay. So based on this, one has to take a view, but definitely if the time limit for issue of notice under 143(2) had expired, then the proceedings are not pending. So therefore, you can file an updated return. Somebody may ask, as I'm reading now, I have a question to myself. It may not be pending, but can I say that it has been completed for the relevant assessment year? Because a completed assessment is also barred. So my view is that the expression completed assessment would mean that an overt act by the assessing officer to complete the assessment by passing an order under section 143(3) or 144 or 147. So he's supporting me for a change. So he's saying that completed in a manner known to the law. So therefore, if these things had not happened, the assessment is not completed, and hence the proceedings are also not pending, and you are not barred from filing an updated return. See, I don't look at the mouth of a gift horse. If something like this comes from when Chythanya agrees with me, I will accept it without reservation. I will not have any ifs and buts on this condition. Next. Then the assessing officer has information in respect of such assessee for the relevant assessment year that under the Smugglers and Foreign Exchange Manipulation Forfeiture of Property Act or Prohibition of Benami Act or the Prevention of Money Laundering Act, and the same has been communicated to him prior to the date of furnishing of the return under this subsection. So if some proceedings are taken under these acts, Smugglers Forfeiture Act, Benami Prohibition Act or PMLA, against the assessee, and the assessing officer has such information with him, and it is communicated to him, it says. So at a first blush reading, to him would say that it means that it is communicated to the assessee. The assessing officer has received information from the other authorities and has communicated such information to the assessee saying that I have information regarding violation of these acts for these relevant years. So that is one view. This, I think, is a plain view of this. But somebody was asking question, why do you say like that? It is the communication of the information to the assessing officer by the other authority. So even if the assessing officer has not communicated to the assessee, but before the date of filing of updated return, he has received the information from the other statutory authorities regarding me, I am barred from filing it. But the view, I think the correct view is, the reasonable view to take would be to say that there should be communication this to the assessee, because it is the assessee who has to take the step of filing the updated return. The action of filing updated return is based on the assessee. If the assessing officer receives something and keeps it to himself, and if he doesn't communicate me, that is his problem. And therefore, according to me, the communication should be to that of the assessee and not the communication to the AO. And such communication should have happened prior to the date of furnishing of the return by the assessee. The next case where it is not permitted is information for the relevant assessment year has been received under an agreement dated 1990 under DTAA, exchange of information, etc. happens, and the department has received certain information in respect of an assessee, and the same has been communicated to the assessee. Here also the same issue, they use the expression communicated to him. Then also it is prohibited if that such communication happens prior to the date of filing of the updated return. Any prosecution proceedings under Chapter 12 have been initiated for relevant assessment year in respect of such person. Now, the language used is very wide. Any prosecution proceeding under Chapter 22 has been initiated for relevant assessment year. Now, if you look at Chapter 22 dealing with the prosecution starting with section 275 and ending with 278, whatever the way, with various sub A, B, C, etc., various sections, you will find that there are certain prosecution proceedings which have no relevance to the assessment year. For instance, that if you fail to deduct tax at source on a payment made, and if any prosecution has to be taken against you under section 276C, according to me, this failure to deduct tax at source is not connected to any relevant assessment year. The deduction of tax at source requirement is based on the date of payment or on the date on which you credit the sum to the credit of the payee in your books of accounts. And it says at what rate you have to deduct tax at source and when you have to pay. That tax may be relevant to one particular assessment year because that is only relevant for the payee so that he can get credit for the relevant assessment year. But as far as payer is concerned, it has no relevance to his assessment year. Though you will find that many 2011 orders will say assessment year so and so, that is irrelevant according to me because that is not there. You may be prosecuted for violating certain this one, not appearing before the AO, etc., which has also got nothing to do with any assessment year. So only if there's a relevance to the assessment year, like concealment of income, non-payment of tax for a particular assessment year, failure to pay tax, like 276C, 276CC, etc., then, sorry, not C, CC, etc., then it will come under this. So therefore, you have to see whether prosecution is with reference to the assessment or prosecution is with reference to something else. If it is not connected with the assessment year, the prohibition does not apply. Then the last one is the board has taken powers to notify such persons as it may deem fit. And if you are unfortunate to fall under that, what has been notified by the board, then also you are prohibited from doing that. Then, so this is the scheme which enables you to file an updated return. So first step is you see whether you come under 139(8)(a), that you are not hit by the provisos contained therein, and hence you can do it. Then section 139(9) has been amended. 139(9) is the one which treats something as an invalid return. And one of the conditions is that if it is not accompanied by proof of payment of the self-assessment tax, then the return can be treated as invalid. The assessing officer has to give you a notice and you have to rectify cure the defect within 15 days. And if you don't cure the defect, it is deemed that you have never filed the return. If you cure the defect, then your return is valid. There is no problem on that. So here now 139(c) says that the return is accompanied by proof of payment of tax as required under section 140B, which we will see later. If the return of income is return furnished under section 8A. Basically what happens is that the presence clause C also says that any self-assessment tax not accompanied by proof of payment of any self-assessment tax. As you would see later, the tax paid under section 140 capital B, which is now proposed to be introduced by the Finance Bill 2020, is also a self-assessment tax. And the relevant clause in the explanation does not say self-assessment tax paid under section 140A. It only says self-assessment tax. So according to us, that expression self-assessment tax would include within its sweep even section 140B payments. So this is really not needed, but this has been done. It is more as a matter of possibly abundant clarification. So if you file the updated return without the proof of all the payments referred to in section 140B, including the additional tax, then that updated return is a defective return and you have to cure the defect within 15 days of receipt of the notice. If you don't cure the defect, it is as if you have never filed the updated return. This you have to keep it in mind. Next. One incidental issue, practical issue, I'm not very sure. I've just thought about it in the morning when I came, because we have not discussed this in our discussion earlier. Along with this 139(8)(a) return, should I file, assuming I have not filed the return earlier, I'm carrying on business. I am liable to get my accounts audited under section 44B. I get the return, I get the accounts audited later, and I have the audit report with me. Should I file it along with 139A return? Because that will depend on what you want to read it under 139A in the prescribed form, verified in such manner, and setting forth such particulars as may be prescribed. So if the return form says like this, you have to, if you're in a tax audit case, please attach all those things. Maybe the answer is yes. But if the return does not say anything about that, you need not attach anyway, but your liability to pay penalty under section 271B already is arisen, because you have not filed the audit report within the due date mentioned in section 44B, and therefore you are liable for penalty under section 271B. There is no doubt about that. I'm not on that. The only technical issue is whether you are bound to file that audit report along with 139A return. What happens if you had filed an audit report earlier? Are you again required to resubmit it? So that all depends on what type of particulars are furnished, what type of return form is prescribed for 139A. So this is what I feel, because this is something which I thought in the morning, and therefore I thought I'll share this with you. We have not discussed among us, so you keep that in mind. So you have to see whether what the return prescribes. If the return does not ask you to include any report, you don't have to include it. You can file it for any relevant assessment year within 24 months from end of the relevant assessment year. That is what the requirement is under 139A. For instance, if you want to file the assessment year 23-24, you have to file it before 26th March, 31st March 2026. You 2 years lapsed. 31st March 2023, 2 years will lapse. But if it becomes an act before that, you can file it. If as will normally happen, the presidential assent will be received before 31st March 2023. So this becomes an act. So therefore you can do that. The practical problem you will face is the return form may not have been prescribed. So you file some return and write a letter to the AO saying treat this as a return under 139A, and then later on when they prescribe the form, try to file it again, get it rejected. And in your case, you yourself can appear in a writ petition. So, but only thing, if you file a revised updated return like this as Narendra Kumar Jain, and you appear in your own case, you have a serious problem because you got fool as a client. A lawyer who represents his own case has got fool as a client. It is not, they'll be filed, that's all. See, as somebody said that in the first case, because most of these returns may have to be filed electronically, through electronic means, you may not be able to file it at all in the first place. Yeah, if it is a physical thing, it's possible. Even assuming that you write saying that it's not allowing me to file, but I want to file it, you send it by registered post, this is acknowledgement due and all those things. If it is a return which is not in accordance with section 139A, it is non-est. You can't. Huh? Okay, fine.
Also,
Okay. Then we have section 140B. There are two sections in that. 140B1 and then 140B2 and 140B3. 140B1, the entire section 140B says how much tax you have to pay along with the updated return. Okay. The first 140B1 deals with the case where you have not filed a return earlier under 1391, 1394, 1395, etc., then what it says is the tax payable on the basis of the updated return would be the tax payable on the total income declared in the updated return after taking into account the amount of tax, if any, already paid as advance tax, any tax deducted or collected at source, any relief of tax claimed under section 989, any relief under section 90, any relief under section 90 capital A, any tax credit claimed under section 115 JAA. All these things are similar to what you find today in section 140 capital A 1A. So from the tax, as if you are filing the return for the first time. Okay, when you are not filed the return earlier, these are this one. So amount of tax, if any, paid as advance tax. So the only point is, if you had filed a return under section 142(1) earlier in response to some notice, and you have paid some self-assessment tax there. Okay. Then the question is whether that self-assessment tax which you have paid earlier can be claimed under subsection 1 as an adjustment. Strictly speaking, it doesn't talk about the self-assessment tax paid, unlike section 140B capital, 140B subsection 2. So if I paid this one or the self-assessment tax on a 142(1) return, and if the view that even a person who has filed the return under 142(1) earlier can file an updated return is correct, there is no specific provision for adjusting that amount. But again, on general principle saying that the tax has to be paid only in accordance with law, the government cannot retain a tax in excess of, except in accordance with law, you can claim the credit even though it is not specifically provided for, is one view on this. Then in such case, what happens is you have to calculate the balance tax payable after taking all these things into account and pay such tax together with interest and fee payable under any of the provisions of this act for any delay in furnishing the return or any default in payment of advance tax, along with the additional tax payable under subsection 3. So all you take, because you have not filed the return under 139(1) in time, you are liable to pay interest under 234A. And so you have to calculate the interest under section 234A from the date on which the original return was due under 139(1) till the date of filing of the updated return, and then pay the tax along with that. Similarly, you have to calculate the interest payable under section 234B under normal provision like a normal return and include that also, and the late fee payable under section 234F also you have to pay. So these things you have to pay under section 140B(1). When you come to subsection 2. Subsection 2 is a case, there is a positive prescription where a return of income under subsection 1 or 4 or 5 of section 139 have been filed. So that is very specific. Subsection 2 will get attracted only if you have filed a return under 139(1) or 139(4) or 139(5), and all those things should be valid returns. If they don't fit in to the under any of these sections, the return filed earlier, if you want to claim that you are liable, you are entitled to file the updated return, you have to necessarily come under 140B(1). To come under 140B(2), you have to prove that you had filed the returns under any of these sections earlier. So this is the first requirement. So if you have done that, what are all from the tax payable on the basis of the updated return, what are all you can deduct? The first deduction is the amount of relief of tax referred to in subsection 140A(1), credit for which has been taken in the earlier return. Under 140A(1A), what are all the credit you have taken? You have taken the credit for the advance tax paid, the reliefs under various sections, TDS amount, etc. And you would have paid also a certain balance 148 tax which is payable. So therefore, that amount also is included in the clause 1 of section 140B2. So whatever interest, advance tax, whatever advance tax, etc. you have paid, plus the other credits and the self-assessment tax paid earlier can be claimed as a credit here. From the assessed tax, you can, from the tax on return, updated return, you can deduct that. Then the second question is that any tax deducted at source or collected in source, which you are not claimed in the original return, and if it relates to the extra income disclosed in the updated return, you can claim. This is provided for in clause 2. Then clause 3 says that any relief or tax or deduction of tax, etc. under section 9091, which you have not claimed in the original return, again, if it relates to the income, extra income disclosed in the updated return. Similarly, with reference to 90A, then the MAT tax under section 115 JAA, not claimed earlier, subject to that condition, increased by the amount of any refund received earlier. So these are the deductions you make, and if you have received any refund earlier, that amount also you add. So you have the tax on the updated return, tax due on the total income declared in the updated return. You have all these deductions. Then by chance you have received a refund in respect of the original return filed, add that amount. So it is something like A minus B plus C. So that amount along with interest. Now here is a very interesting situation in section 140B2. It says the associate shall be liable to pay such tax together with interest payable under any provision of this act for any default or delay in payment of advance tax. Now look at the 140B1. 144B1 says not only for the delay in payment of advance tax, it also includes for delay in filing the return. And it also refers to fees separately. And then the later portion says that along with the tax, you also pay interest and the fee. Tax, interest and fee you have to pay, that is under 140B1. But here the interest which is referred to in 140B2 is only for the advance tax shortfall, which can be either under 234B or 234C. So this is a lacuna. But then, does it mean that in respect of such additional income, which you have declared in the updated return, you are not liable to pay 234B interest at all? The answer is no. Because all these things are some kind of a self-assessment tax. Possibly for self-assessment tax, you may not include that interest under 234A. But when it comes to assessment by the assessing officer, he has to necessarily take into account 234A, and under section 234A, he would be liable if there was a return, original return was delayed. Let us say 139.1 return is delayed and you have filed it under 139.4. You would have paid 234A interest on that delay on the basis of the balance tax payable on the basis of that return. But now on the extra amount of tax which you are liable to pay, you have to pay interest on 234A for the original period of delay. If the original period of delay of about 2 months, you will pay 2% interest. Let's say if it is 4 months, you will pay 4% interest on the extra tax computed under section 140B. So the lacuna is section 140B2 by not referring to an interest on delayed filing of the return gives you a temporary respite of not paying 234A interest, but when the assessing officer makes an assessment, he will demand his pound of flesh by charging you 234A interest for the original delay, if any. Then another thing you will notice is that it does not say fee. It only says tax along with interest for delayed payment of advance tax. It doesn't use the word fee. But if you see the last portion, and the return shall be accompanied by proof of payment of such tax, additional income tax, interest, and fee. Again, this is something which we did not discuss in our meeting. It escaped our attention at that time. So I was looking at this in the morning, and I would say that my view is that fee cannot be charged under 140B2. So
Yeah, we had not discussed it, but the fee for late filing would have already been paid in the prior return. Unlike in the case of 234A, where there is scope for increase of interest on the basis of enhanced income, there is no such scope available. Therefore, rightly in 140B subsection 2, they are not put for fee, although the word fee which comes at the end is a mistake.
okay, so that's all. I agree with that. So the point today is, one way of looking at is, somebody, see, I would have already accompanied, I would already send the challan along with the original return for late payment, or given the reference in my return. So why do you want it again? Is an issue. But anyway, as Chythanya explains, is that it is an error in fee. So it doesn't mean that you have to pay any extra fee or anything like that, because whatever fee was payable has been paid. For late filing fee has been paid, and that amount does not get varied by the tax determined on the updated return. So since it has nothing to do with the tax on the income, so it makes no difference, no effect on that. Okay, fine. So having done this, now the subsection 3 of 140B would say that what is the additional tax you have to pay? The additional income tax payable is depending on when you file the return. Whether you pay within a period of 12 months from the end of the relevant assessment year or 24 months. If you file the return within 12 months from the end of the relevant assessment year, then 25% of the tax plus interest has to be paid as additional tax. If you file it after the expiry of 12 months, but before the end of expiry of 24 months, you have to pay 50% of the additional tax on that. Okay. Then you have subsection 4 of section 140B, which deals with 234B interest calculation for the purpose of subsection 2. We saw that subsection 2 says that any interest payable for shortfall in payment of advance tax or non-payment of advance tax is to be paid along with the return. Okay. So now it only says how do you calculate that? What it says is that it modifies the calculation of interest which is provided under section 234B by changing the assessed tax definition. Under 234B explanation 1, there is an assessed tax definition. It says how the assessed tax is to be calculated. All section 140B4 does is to modify that explanation 1, the definition of the assessed tax. How assessed tax is relevant? The assessed tax is relevant to find out whether the advance tax paid by you is more than 90% of the advanced, the assessed tax, is the difference is less than 10%, or let us say that the advance tax paid is 90% or more than the assessed tax payable, then you are not liable under 234B. If it is less than 90%, you are liable under 234B1. So that is how the assessed tax becomes relevant for that. Now subsection 4 of 140B says that there will be a modification of the calculation of the assessed tax. So how that happens is this. Before that, I want to say one thing. It only modifies the assessed tax But after all these things, if you find the advance tax paid is more than 90% of the assessed tax as calculated in 140B4, then you are not liable to pay interest under 234B1. As somebody has asked earlier that even in the updated return, if the final amount claimed is a refund, but which is less than this one, then also there is an issue because the refund, etc., which is to be done has to be increased. So therefore, a case of a reduction of refund may result in payment of interest under section 234B, whereas normally a refund case 234B will not be attracted. Okay, now subject to this rider, what are the things you can make an adjustment from for calculating the assessed tax? The amount of relief of tax referred to in subsection 1 of section 140A, the credit for which has been claimed in the earlier return, the tax deducted or collected at source in accordance with chapter 17 on any income which is subject to the deduction and which is taken into account in computing the total income which has not been included. This is similar to what we saw. Your claim declares an additional income. On that, some tax has been deducted at source or collected at source. You are not claimed in the original return. Now you are claiming it. So that is similarly relief under section 90, 90A, etc., and the relief under the MAT tax, and as increased by any refund which is granted earlier. So under these circumstances, this is how you will calculate that as the assessed tax. Then compare that advance tax paid is whether 90% more than that or less than 90%, and then accordingly pay the this one. But for calculation of the assessed tax, please understand additional income tax is not taken into account at all, because to ensure that there is no iterative process, section 234A and B has been said that you don't have to pay interest on 234A and B on the additional income tax. So this is by and large. Then you have the, sorry, I'll just complete this explanation, which says that interest payable under 234A for the purpose of subsection 1 shall be computed on the amount of tax on total income as declared in the return under section 139(8)A in accordance with the provisions of section 1A of the Act. So this is again fixes the terminal point for calculation of interest. Then interest payable under section 234C for the purpose of subsection 2 shall be computed after taking into account the total income furnished in the return under 139(8)A. Because 234C interest is always with reference to the returned income. So they say when you want to calculate 234C interest, please see the tax on the returned income under 139(8)A, not the original return. Then interest payable for the purpose of subsection 3 shall be the interest chargeable under any provision of this Act on the income as per the return furnished under subsection 8A of section 139 as reduced by the interest paid in accordance with the earlier return. This is also similar to 234A return calculation. Then provided further that for the purpose of this clause, the interest paid in the earlier return shall be nil if such return is an updated return referred to in subsection 1. Now this is something which you are not able to understand. We saw earlier that you can't file a second updated return at all. So how can the earlier return ever be an updated return? It says that interest payable shall be paid in the earlier return shall be nil if such return is an updated return under 8A, under referred to in subsection 1. So the question here is that I am not very sure how is it ever possible, because you can file only one updated return. So there can't be an earlier updated return. That is what we felt, and we just left it at that. We couldn't find an answer on that. So with this, since the time is running out, we will not be able to take any questions. But if any of you have any questions on this, you can send a mail to the branch. I'm sure they will forward it to us, and to the best of our ability, we would like to answer. So now I request for them to take off.
we will see the scheme of assessment. Broad headlines of 144B and changes to reassessment. With the paucity of time, we'll go into the scheme in a manner to say how the flow happens. We'll not go into too many nitty-gritties of the scheme concerned, but we will try and capture the new scheme that is happening now, effective from assessment year 23. We are looking at a NFAC, National Facial Assessment Scheme, being the hierarchy, the top body concerned. That will take a case for scrutiny on the basis of what parameters the board may lay down. Having said that this is a case that is fit for scrutiny, it will assign that to an assessment unit by an automated process. So it goes to the assessment unit concerned. So case selected, assigned to a assessment unit. What should the assessment unit do now? And when it says that I'm going to take the case for scrutiny and assign it to an assessment unit, before that, it also intimates the assessee concerned to say, look here, your case is going to be now done under the face-to-face process that now given to us under 144B. It's gone to an assessment unit now. What should the assessment unit do now? Assessment unit says, I'll give you a notice under 143.2 or 142.1. And you'll have to respond to that in the time that I'm defining in that notice concern. If you don't comply with that time, there's a consequence to say that 144B type of an assessment can be made on you. Interestingly, it's important also because when we get a normal 143.2 notice, in practice, we go to the assessing officer and say, what is the position, what details you want? We don't reply officially. But then you have to be very sure now that 143.2 notice comes to you. Whatever manner, you have to respond to that on record to say, I've replied to that 143.2 notice. 1. 2. Rightly or wrongly, in this process now, in a response to 143.2 or 142.1, what time limit the AO mentions, you can't ask for an extension of time. Although at other places they said you can ask for extension of time. There's no mention made. Although if there is a valid reason, nobody should refuse or can refuse that. But in terms of the language that is used in the statute concerned, you don't have an explicit mention of an extension of time to the first notice received by you under 143.2 or 142.1. So you get a notice under 143.2 or 142.1. Next, AO says, these are the parameters that have been basis on which this case has been selected for scrutiny. I want some further information. I want to conduct some further inquiry. Therefore, he can correspond with the assessee or with anybody else. Somebody else who has information relevant to the assessment concerned, to that person they can say, kindly give me the relevant information or the documents concerned. So, directly with the assessee under 143.2 and 142.1, another notice to the assessee, I want further documents concerned. Second level of interaction with the assessee. The third level of interaction can happen by the assessment unit with the verification unit, telling him or telling that unit concerned, I want certain verifications of certain points or certain documents or certain evidence, certain books of accounts. Verification. And the fourth could be that he says, I want an technical assistance from the technical team. Could be on valuation, could be on transfer pricing, could be whatever matter concerned. I want the assistance of a technical unit. So looking at 4 broad levels of interactions initiated from the assessing officer, in response to which certain actions have to happen. The law believes, yes, that the verification unit and the technical unit are going to furnish that information called for. Only in relation to the SSC, they are looking at a situation where the SSC may respond to 143.2 notice, may not respond to the 143.2 notice. Yes or no? Second would be a case where when the assessing officer gives you an inquiry, then that may be to the SSC concerned or to a third party concerned. We are looking at a situation where the SSC may respond, SSC may not respond. We are looking at a third party, he may respond, he may not respond. So the department inter-se response is therefore saying assured, guaranteed, it will come back to the assessing officer via the NFAC. All this process of via NFAC, I'm not going into detail. Only looking at the board process concerned, we have to be very sure that these interactions can happen only via the NFAC. So the response will come. With the SSC, he may respond to 143.2, he may not respond. With the third party, he may respond, he may not respond. The third party does not respond, there are no consequences. Nothing can happen. Assessee does not respond to this notice, there's a possibility of an AO saying 144 type of work can happen to you. When you respond, then the SSC has all the information that he is having from the assessee, from the technical unit, from the verification unit. So look at two situations concerned now. Assessing officer has responses from everybody to one action. Assessing officer has a statement that the SSC has not responded, another type of action. So when the SSC has not responded, then the assessing officer will give a notice under 144 type situation to say, why should our assessment not be completed in the manner laid down under 144? You have an opportunity to respond to this notice. So the default made by you in not responding earlier can be made good by responding to the notice under 144. You may not again respond also. So again, imagine this situation concerned. You respond to 144 notice. You don't respond to 144 notice. When you respond to 144 notice now, that means there's already one response already available. All of this will be gathered with the assessing officer concerned. So now he has all information available with him. When there is no response, there'll be a notice to the SSC, why should assessment not be completed in accordance with the procedure laid down under 144. So no response, assessing officer says, I'll complete the assessment to the best of my information, best of my judgment, based on materials available. Response is received from all the divisions concerned, he has certain material available with him. At this point of time, he says, I think I'm going to accept everything that the SSC has said. He may do so also in case of 144 to say, I want to accept everything and nothing is there for me to bother at all. I will accept, though you're not responded, there's nothing for you to be worried about, there's nothing adverse to you, I may accept that. So when response comes or when no response comes, he may say, I will accept the return your file. At that point of time, he prepares what is called as a income determination proposal, income or loss determination proposal. So one level of culmination of proceedings here. To say, I'm not going to trouble you at all because of the responses received from you, from the verification unit, from the technical unit, or even when there's no response from you, I think there's nothing to be done in your case. I will accept, my proposal is to accept your return as your file. Therefore, at that point of time, he prepares the income or loss determination proposal. He says, no, I'm not very happy with the return to your file. I want to make some variations now. Variations could be because of the information given by the SSA, by a third party, by the review unit, by a technical unit. He has all this material available. He says, by virtue of this information, now I think I want to make a variation to your returned income. At that point of time, what should he do now? He'll issue a show cause notice to the SSA further. He has even one notice earlier. He's now going to give a show cause notice to say, these are the points on which I'll try to make an addition. Kindly give me your response to these proposals concerned. Show cause notice will come. Show cause notice will come, and then what will happen therefore now? Show cause notice, I respond, I don't respond. Okay. When I respond to the show cause notice, now the material comes back to the assessing officer concerned. And let us say therefore at that point of time, he will say, this is the proposal I'm going to make in relation to your income because of the materials you have gathered, because of your responses concerned. I now will make the income or loss determination proposal here. So one more stage of income or loss determination proposal, where no addition, no changes are made. One, where he's trying to make changes, he has responded to everything, got the response, got the material, and he's come to some conclusion now that this income should be X, Y, Z. So income or loss determination proposal is now available. So these two, therefore, are now available at the NFAC stage now to say that, hey, the AO has made a statement, no changes to be made. AO has made a statement, changes to be made. Both these go to the National Faceless Assessment Center. The National Faceless Assessment Center would have received guidelines from the board, and those guidelines may be given in what manner the action has to be taken in relation to this income or loss determination proposal. They may say, therefore, this income or loss determination proposal needs to go to a review unit. Or they may say, no, accept it and complete what is called as a draft order concern. So we're looking at, therefore, the guidelines being applied, giving rise to two consequences at the NFSC level. One, to say that, hey, accept this, and therefore, from a income or loss determination proposal, move to a draft order stage. Earlier schemes all talking about order, revised order, draft order, revised draft order, final draft order. Now they're making different terminology, using different terminologies. Therefore, they're going to have a draft order prepared at that level where nothing is there, no guidelines are required to be applied. So imagine this draft order stage at this point of time. Take a case where they say, no, because of the board guidelines, this assessment order as done, the draft income determination proposal as done by the assessing officer is not very happy. It has to go to a review unit, therefore. Therefore, then the matter will be sent to a review unit to say, kindly look at what the proposal is given by the assessing officer. Board guidelines are saying this has to be looked into by you again. So kindly look into this order concern. The review unit will go into the entire conspectus and prepare a review report. The review report may accept what the AO is saying, may delete some portion or all portion of what the AO is saying. They may also have some other hypothesis to be added or some other points of their own to be added. So a review report is going to be prepared. That review report comes back to the assessment officer, assessment unit. When the review report comes back to the assessment unit, the law now provides that the assessing officer may accept or may reject the proposals given by the review unit. He may accept, he may reject. If he is rejecting, he has to make a statement, why is he rejecting? If he is accepting, nothing is to be done on this matter. So at that level, therefore, he will now, after the review unit is over, and after his acceptance or rejection based on the law that is provided for, he will then prepare a draft order. So this is the stage by which you are moving from an income or loss determination proposal to a draft order proposal. This draft order comes now where it comes back to the NFAC. What should the NFAC do now? NFAC will find out whether this was a 144 case originally, we have a situation, all this process again, we have a situation concerned. We come to therefore draft order situation concerned, at which stage NFAC will ask a question, hey, whom does this order pertain to? Does it pertain to an eligible assessee? Does it pertain to some other assessee? If it pertains to an eligible assessee, that you issue the process to under 144C, draft order has to go, it has to go to the DRP possible, that route will be taken. If it is not, it is not a eligible assessee, then the NFAC will tell, kindly convert this draft order into a final order. A final order is prepared. If it goes via the eligible assessee, it goes through the entire route of objection being filed, no objections being filed, then the DRP giving the direction concerned. On the basis of DRP direction, it goes back to the assessment unit. He will again then, in conformity with those directions concerned, prepare the final order. And if there are any penalty reasons because of the violations throughout the process concerned, along with the final order, he will also issue a penalty notice. This is the sum and substance of all the 25 subsections given in 144 capital B. There have been significant changes. We have to be therefore mindful. What happens now is, we got to be sure about different types of schemes we are handling now. There is a current 144B which we will be required to handle. There was 144B as existing last year. We're going to handle that. There was a faceless assessment as per the scheme, not as per the statute, 143(3)A. We may have those assessments to handle. There may be prior to the scheme also some assessment for which the time would have got extended for some reason whatsoever. Because of 153, some extensions are available. Those assessments will also be pending. So question therefore arises, when there are different types of assessments and there are different types of processes concerned, what should be the way in which we could look at the legality of the order concerned? Are we going to make a statement that the respective schemes will govern the respective process of assessment or respective laws will cover it? Or you're going to make a statement, no, now this is a procedure for assessment. The new laws they're going to take over. If you're passing the order after the new law comes into the picture, you'll have to follow the procedure laid down in the new law. We could give any answer, but this is going to be, in my opinion, worth examining and challenging. If you think that there is something that is very adverse to you, we have to look at this technicalities also in a very serious manner. Although, since it is a procedure for assessment, procedure should have retrospective effect. That's one way of looking at things. And therefore, if it is retrospective effect, then the ongoing law that is there on the time, at the point of time when you are completing the assessment, that should be the law governing the manner of doing the assessment concerned. There could be, therefore, I'm saying technical flaws in the entire process, in the entire journey concerned. Therefore, you have to be very mindful of the fact that if there are certain slip-ups in relation to the entire process concerned, what slip-ups, by the current law slip-up, by the erstwhile law slip-up, our job is to therefore find those slippages concerned and say that there was some thing in my benefit, to my benefit, that process has not been followed. Therefore, kindly look into the legality of the assessment order concerned. There's going to be, in my opinion, a huge challenge to the legalities of order passed because nobody knows how to go about this. There's no clarity. There's nothing in the section concerned also to say that what will be the governing factor in terms of completion of the assessment concern. This is one. Two, there have been certain changes now, fundamental changes. Briefly, we'll therefore go into. We are looking at therefore different types of schemes concerned. That's one part of the story. The other part of the story would be that we are looking at different authorities concerned. So we would again ask this question that if there are various authorities concerned, what is the hierarchy between the authorities concerned? We have the assessing officer, we have the technical unit, we have the verification unit that is getting involved. Okay. Now, verification unit, the AO can actually reject or accept. What about technical unit? Is it binding or not binding? The law is not laying down very clearly. Only for verification unit, just saying, yes, this is going to be the position concerned. They want to be very careful, therefore, the hierarchy and the binding nature concerned. You also start juxtaposing this with other provisions of the Act. We start immediately. Our job is therefore to find out how does this scheme interplay with everything else that is laid down under the Act. We talk about what? We talk about transfer pricing because it's an international transaction. What does 92CA tell us? That there has to be a reference. Reference by whom? Reference by the AO to the TPO. Reference after what? After the approval of the CIT. So that is the process laid down under 92CA. Is there a process laid down under 144B now? Because the transfer pricing officer is a part of the technical unit now. He is a part of the technical unit now. When he is a part of the technical unit, are you going to make a statement that the entire procedure laid down under 92CA has to be incorporated or has to be bodily lifted, and you have to therefore make a statement that there has to be an approval by the commissioner before you make a reference to the transfer pricing officer? Is this going to be an order under 92CA or is it going to be an order that's coming into draft under 144B? So there are going to be a lot of things that we will have to look into when we start playing down various sections, various provisions of the Act, which are the procedure laid down under 144B of the Income Tax Act. What's also important for us to understand is that in the process of going about the scheme concerned and laying down, the interaction between the assessee and the department concerned, look at the way they've gone about. I made a reference to the fact that the assessing officer, when he says, I'm going to make a variation to your income return, at that point of time, he gives a show cause notice to us. He gives a show cause notice. Then he prepares the income and loss determination proposal. It goes to the NFSC, it may go to a review unit, and then comes back. Now, we made a statement also that the review unit can make variations. The AO may accept, the AO may reject, AO may add something more at that point of time. The law is not visualizing a show cause opportunity to assess at that stage. That's an unfortunate position concern. The law doesn't look at, the law only looks at a show cause notice but at some anterior stage, at some earlier stage. When you're coming close to the income determination, to a draft order concern, which draft order has gone through significant variation from the proposals made in the show cause notice. Technically speaking, it should have been a situation where the SSC ought to have been given another opportunity to meet those grounds. Law is not providing for. One scheme is not providing for. It will therefore be mindful of the fact that if no opportunity has been given to you, then you have to make a statement that this is an order bad in law because the procedure, the natural justice has not been met in this case concerned because we've gone much beyond the show cause notice without giving me an opportunity to meet that case itself. It's important, therefore, for us to be extremely mindful. And the law would say, therefore, at the end of the journey concerned, the records will be given to the assessing officer. They'll pass on to the assessing officer. Now, we should try and find out and make an inquiry with the assessing officer as to what journey the record went through, whether it went through verification unit, went through a technical unit, didn't go through anything else, because it's extremely important for us to know the journey it went through. If there is a revision tomorrow, if there is an action by under 263, then we have to make a statement, look here, it went through all of this as process concerned. Everybody has applied their mind to this. When they've applied their mind to this, where's the question of there being an error in the order passed concern? Extremely, therefore, important for us to look at the entire journey and ask for those records and ask for those traveling details. What's also important for us to understand was there was one section called 144B9 to say that any order passed not in accordance with the 144B as presently existing shall be non-est. That means they mandated that whatever be the assessment year it relates to, whatever be the scheme governing at that point of time, if it is completed after 144B came into effect and the order was not in compliance with 144B mandate as laid down in the statute concerned, that order was said to be bad in law. They have removed that section concerned now. They have removed that section. If you have that philosophy built in, we can say new scheme not being complied with, the order is bad in law, is non-nest in law. But they have removed that section, possibly indicating that no, we will not give that latitude to SSC concerned to challenges on this manner. There could be lapses throughout the journey concerned. If you were to statutorily provide this non-nest in law, we are hitting ourselves badly. Let the SSC challenge in appropriate cases as to what he wants to say about the validity of the assessment order itself. Subsection 10 also has been deleted in terms of the verification unit's role concerned, not very relevant for us. The method of giving the notification concerned, the method of communication concerned, the aspect of physical hearing given to an assessor concerned, the standard operating procedures to be laid down, these are extremely important. We are therefore be mindful of these procedures laid down, because there have been very interesting the standard operating procedures laid down under the current 144B. They've gone a little beyond the act itself. They've gone a little beyond 144B. So extremely important for us when SOPs come for the new scheme also, if they're going beyond the statute in our favor, we've got to be mindful of the requirements or the conditionalities laid down therein. And if the department does not fulfill those SOPs concerned, we could then again challenge the assessment order to say not in accordance with the mandate, because the law says SOPs shall be given and therefore they get the power of law. And if you don't comply with that, it will be in violation of 144B. Therefore, important for us to look into these aspects concerned. The most important difference in my opinion is the fact that earlier law under the current 144B, the NFSC was the assessing officer concerned. Now they're saying no. They're saying assessment unit, technical unit, verification unit, review unit, they're calling that. But when they call that, they're saying this assessment unit or review unit shall mean an assessing officer in that unit concerned. So ultimately, they're making a statement. All the persons who are at the JCIT level and the ITO level in that assessment unit, technical unit, or the verification unit, or the review unit are all going to be called as assessing officers. So if I am in Bangalore, I am having an assessing officer in Bangalore, my case may go through the assessment unit concerned, may go to a technical unit, may go to a review unit, may come back and go to a verification unit, may come back and go to a review unit. That journey between various officers concerned would be a journey where it moves to more than one assessing officer. And it's important, therefore, for us to note that it's going to be a situation where possibly all of these officers concerned, in all of the units concerned, are going to have concurrent jurisdiction over one particular assessing. Earlier, the issue was NFSC was the assessing officer. Now they've changed that to say every unit will be the reference to a unit will be a reference to an assessing officer in that unit concerned, and he will have jurisdiction over the assessee concerned. Who are the persons who are going to be governed? The board says we'll notify the class of cases, class of income, all those persons will notify. Lastly, they'll make a statement that most of the cases they say will be classified. They may, by choice, say, I'll move the case back to a regular assessing officer. They may, by choice, say, I don't want this to handle. It's too complex. We can't handle through the patient assessment scheme. I want it to be handled by the local assessing officer. This is happening currently in relation to search cases, in relation to central investigation, central circle cases, to say those are not being handled by the NFSC, not through facial assessment scheme. They were handled through the regular officer concerned. One more provision is made here that if your accounts are complex, voluminous, and therefore the interest of revenue is involved there, once they appoint the auditor under 142(2)(a), it will go back to the regular officer concerned for the purpose of completion of the assessment concern. So these are the broad modalities of 144B procedure laid down. We now go into income escaping assessment. Look at the broad outline of the law itself. 147 deals with the income escaping assessment. 148 talks about the notice to be issued. Before you issue a notice, a procedure has to be complied with. 148 capital A therefore talks about that procedure, talks about inquiry before a notice is issued. Inquiry before a notice is issued. 149 talks about the time limit for issuance of a notice. This is the broad we are familiar with. What's important for us to be always mindful of the fact that the old understanding of ours, vis-a-vis the way we went through all the judgment, all the case laws, have to be given a go by now. You have to be very careful. If you're looking at the old law, what is the spirit of that law, which will be applicable? Or also be mindful of the fact that because of the change in the scheme itself, the old law, old findings or old conclusions may not necessarily apply. For example, we had the old law to say, if the assessing officer has reasons to believe, that is not there today. If income is escaping assessment, then something can happen. The reasons to believe are not there. When the reasons to believe are not there, you are looking at the change of opinion also as a factor or a part of the reasons to believe. So change of belief, change of opinion also, we are looking at very strongly. The change of opinion not permissible under 147. That's happening because change of opinion was a review. Review was different from the reasons to believe. Therefore, they're saying, no, you can't have a review, you can't have a change of opinion. That goes against the grain of the reasons to believe. Therefore, we will not allow you with that. We also have the protection given to us for full and true disclosure under the proviso, under the erstwhile proviso. All these, therefore, don't work under the current dispensation. They say, if income has escaped assessment, what do you mean? What are the basis for this conclusion? The basis for this conclusion is that there is some information with the assessing officer which suggests that income has escaped assessment. That's all. So it's extremely important for us to understand now the contours of 147. On what is it based today? It is based on income, which is information which is with the assessing officer, which suggests that income has escaped assessment. With that, she can go on to issue a notice under 148 and complete the assessment. So information with the assessing officer which suggests that income has escaped assessment. What do you mean by this income? Not income, information available with the assessing officer suggesting that the income has escaped assessment. What is that? Those are of two categories now. One, I'll go to the easier category. The law itself creates a fiction that in these situations concerned, income is mandatory, information is mandatorily said to be available with the assessing officer. Mandatory. In these situations concerned, it will be deemed that there is information with the assessing officer that income has escaped assessment. Beyond that, the law says there could be other circumstances under which I can have a statement of law to say there is information with the assessing officer which suggests that income has escaped assessment. Only suggesting, which is only suggesting now. Now, what does the law therefore say? That where there is a statutory fiction created, that in these situations concerned, there is definitively an information suggesting income has escaped assessment. Then what should you do now? There's a proposal given in 148 capital A, which says that how do you go and make inquiries? How do you go about getting an approval? How do you therefore pass a formal order in 148 capital A, which order is the basis for a notice under 148. That procedure is not required to be followed. That procedure is not required to be followed. Therefore, when there is a statutory fiction available to support the assessing officer to say, in these circumstances, there is a statutory fiction created that there is information that suggests that income has escaped assessment, you directly move into 148 notice being issued. 148 has to be with approval of specified authority, but the whole procedure of 148 capital A is given a go by. We'll come to what are the instances, but let us understand the broad outline of the law itself. The next is where there's no statutory fiction. What does it mean, therefore? It will be the assessing officer's job to demonstrate very categorically that I had information in my possession that suggests income has escaped assessment. So there will be something more on the assessing officer tomorrow if we were to challenge it by following the GK and knife trap process concerned. It will be assessing officer's requirement to demonstrate the satisfaction of the jurisdictional fact that he had certain information with him that which suggested that income has escaped assessment. Therefore, that information which suggesting that income has escaped assessment is to be broken down into two broad categories: jurisdiction as a fact, jurisdiction as a fiction. Jurisdiction as a fact, assessing officer has to prove that yes, there was information with him. He did not act just casually. He did not act on whims or fancies or on certain rumors or gossip. He has to therefore demonstrate he had information which suggested that income has escaped assessment. Where this is a fiction. What fiction? Statutory fiction. Therefore, there's nothing else for the assessing officer to do in relation to responding to this aspect concern. So what are these instances is extremely important for us to understand. And there are laws, the changes in the law are in relation to these conditions itself. So what did the law say? I will look at the issue where jurisdiction is of fact. That means the AO would be required now to demonstrate that I have some information suggesting income has escaped assessment. What are those conditions? Two existing conditions are there. The RMS, information available through the RMS. There's a word flagged was there. They said, no, cancel the word flagged. They cancel the word flagged. So information available through the risk management strategy, that information reaching the assessing officer will be a case where assessing officer will get the information. Then he has to come apply his mind to say, yeah, by virtue of this fact concern, I think in the case of this assessee, income is said to have escaped assessment. There's a suggestion available to me from out of this type of a fact concern. Second condition earlier was that a final report of a C&AG, final audit observations of the C&AG. That was reasonable culmination of a lot of processes concerned by which there was interaction, and then ultimate C&AG would give a final observation to say, in this case, income is escaping assessment. They have now removed the word final objection. They've also removed the reference to C&AG. They said any audit objection from anybody, from whatever be the hierarchy, in whatever process will be concerned, that will be a situation where that information goes to the assessing officer. It will be a case where there is a suggestion available to the income tax officer concerned by virtue of this to say that income has escaped assessment or income is likely to escape assessment. Again, this will be a case where the AO has to prove now that I got this audit objection, I applied my mind, it came to a situation where yes, income is said to have escaped assessment or is a suggestion concerned. They got a message that we need to close by 7. Let me complete this point at least. Let me complete for the benefit of, there's a continuation now, continuity there. Let me complete this point and then I'll take a question. I don't know. They're saying another 14 minutes more, 15 minutes more only. Third would be there are 3 new additions now. So there were 2 regions originally. They've added 3 more new regions now, where jurisdiction by fact can come about. Information coming to me under section 90 or 91 of the income tax act. That means cross-country information, automatic exchange of information, article 26 of the treaty concerned, which gives information that can lead to a conclusion of the assessing officer concerned that there is income. There is suggestion available to me that income has escaped assessment. There is also an information that comes to the assessing officer by virtue of the procedure laid down under 135 capital A. There could be a faceless collection of information by virtue of 133 capital V, 133 capital C, 134, 135. A lot of information could be collected. That collection of information is now happening through a faceless process concern under 135 capital A. If there's information by virtue of the procedure laid down there and that information is available to the assessing officer, it can give rise to a situation or a belief, or not belief, can give rise to a feeling to the assessing officer that income is now escaping assessment. That suggestion will be available to the assessing officer concerned. And the last is any order passed by a tribunal or a court which requires particular action to be passed in consequence of the order passed there. So if there is an action that is required or that is mandated, that is recommended by virtue of the order of the tribunal or the court concerned, in that situation, it will be a case where this information flowing to the assessing officer can give rise to a presumption now that there is a suggestion of income escaping assessment. So these are 3 new added cases now. After this, all these cases concerned are therefore something that the assessing officer has to struggle to establish tomorrow, or put it differently, I can challenge the ultimate conclusion drawn. Why did he issue a notice? There is no information with him which suggested that income escaping assessment. I can challenge this. Out of these 5 cases, they have picked up one to say what comes to you under 135 capital A by virtue of the faceless collection process concerned. This you cannot challenge. This will be a case where 148 capital A procedure will not be available. So it will be a case where the entire process of passing an order on 148A will not be there. It will be a case where 135A can automatically lead to 148 notice with the approval of the statutory authority concerned. So out of 5 cases of the statutory fiction concerned, I can ask for, the only thing I have to do is, I can't challenge the fact that the AO, in case of 135A, did not follow the procedure laid down under 148 capital A, because 148 capital A says, before you issue a notice under 148, a particular procedure has to be followed. You have to conduct an inquiry. You may therefore intimate the SSA, consider his material, and pass an order concern. Clause D of 148 capital A says, pass an order concern. and that order has to be passed with the prior approval of the specified authority, giving rise to a notice being issued under 148. That procedure is not required to be followed in case of information coming under 135A. It will directly lead to 148 notice, but nevertheless, it falls in the case of jurisdiction by fact, and I can challenge at any point of time. Next will be case of all the cases where there is no requirement of an AO following. There's a statutory fiction available. Which are the cases of statutory fiction available? Search, survey. There were two types of surveys excluded. The tedious survey and expenditure survey, 133A2A or 133A5. There were two types of surveys. This type of surveys, by the erstwhile law, were not giving rise to a presumption that income is escaping assessment. There's no presumption there. But they've cancelled one of them now. 133A5A, expenditure survey. If expenditure survey is happening and there is information available, then it falls into now a statutory fiction now that this information available gives rise to the IO having a natural belief that income has escaped assessment. That changed there. Next would be a case, therefore, search and seizure happening. Search is happening in some other else's place and they find assets of mine there. Search is happening in somebody else's place. They find documents or books of accounts pertaining to me or relating to me. Those are two added cases. These are existing cases itself. And therefore, this will be a case of statutory fiction of income where the assessing officer naturally has a statutory support available with him to say information available with him suggesting income has escaped assessment. Now, these have to go back to 148A and then you give a notice and go over. We will not go into all of those conditions. Important that we have already seen that in these conditions, no 148 capital A procedure is required to be drawn, that inquiry order not required. And out of the jurisdiction by fact, 135A also moves out, no 148A procedure is required to be drawn. Information is available. I have to now start finding out what is the time limit for me to issue a notice. But now, before that, I was looking at this statutory fictions available, that search, survey, the deemed third person survey and all that. The law earlier was saying that the fiction there was only for a period of 3 years, not extending beyond that. Now they have removed that fiction now. They said nothing. This can go up to 10 years also, being the maximum time period for you to issue a notice under 149. So that limit of 3 years is removed out. 10 years the fiction can extend into. So therefore you have to go back to find out what is the time limit for me to issue a notice under 149. Normal 3 years, 10 years extended, some situation. What are the conditions for 10 years extension? 10 years extension is provided the AO has reasons to believe that income escaping assessment is more than 50 lakhs. Condition number 1. Now, very interesting that if you look into the law as amended last year, they said 50 lakhs should have been the income escaping assessment for that year. They have removed the word for that year now. They have removed the word for that year. Extremely important for us to understand. They have removed the word for that year. That means if I find for last 10 years an aggregation, and therefore the aggregate income shows income escaping more than 50 lakhs, then AO will have the power to go about issuing notices. So if more importantly, the word for that year, the terminology is removed. Now, very, very interesting, 149(1)A has come in, and that's an important provision. So what the law says, and I'll give you an example to understand this law. Law says, therefore, that if the income is escaping assessment, and I'm looking at the aggregate amount of information, not per year information. Okay. So if that exceeds more than 50 lakhs, I may issue a notice to you. Now, this has to be 50 lakhs as what? Income escaping assessment. But this should be represented by what? Represented by, last year the law was only an asset. This year they've added 2 items further now. So income escaping assessment represented by an asset or represented by an expenditure. That means you had income, you've blown it away for some reason, personal expenditure, official expenditure not recorded, whatever you have done, blown away. Therefore, it's an expenditure born out of the income that also can give rise to 149 notice. And third would be any entry in the books of accounts. Chaitanya was explaining about those fictitious nature of expenses concerned. All these three giving rise to more than 50 lakhs of income can give rise to a 10 years opening. The 149(1)A has a very interesting statement. It says, if this is an income, okay, and I'll take an asset example. We'll be able to relate that very easily. So I have, let us say, I'm going to more than 3 years. And take a simple example. That's the example we discussed also. I'll relate the same example. So 4th, 5th, 6th, 7th, 8th, 9th, 10th year. I have earned 10 lakhs each year, which has not been disclosed to the department. So I've had 70 lakhs. Has it gone beyond 50 lakhs? The answer is yes. Now, I have out of these 70 lakhs now, in the 4th year, I made an FD for 40 lakhs. In the 7th year, I made an FD for the balance 30 lakhs. So whatever you want to go about, come to say year 1, 2, 3, 4, 4th year 40 lakhs, 5, 6, 7, which is coming now to close to the current assessment year now. I have invested 30 lakhs now. So have I had income? Yes. More than 50 lakhs? Answer is yes. Has it found its way into an asset? Answer is yes. Now look at 149(1)(a) very closely. It says that this income should have represented itself in the form of an asset. Okay. Then in the year in which the asset is shown to exist, I can give a notice for that year. This is extremely important. Not just the fiction or the fact that I have incomes escaping assessment of more than 50 lakhs. It has to go back to that year in which the income has found itself or translated itself into an asset or into an expenditure. This is extremely important for us to understand. I'll repeat again, 10 lakhs, 7 years, 70 lakhs. Basic condition of 149 to go to more than 3 years, up to 10 years is satisfied. Now, the precondition for 149(1)(a), 1 capital A, is that if this has found itself into an asset, then I shall issue a notice for those years in which the asset is said to exist or said to have been invested in. Out of the 7 years now, in how many years have I invested? In 2 years now. So 149(1)(a) says we shall issue a notice for these 2 years only. Okay. Now, very interesting. Take it forward now. What is the investment made by me for that year? 40 lakhs and 30 lakhs. What is the income escaping assessment in that year? 10 lakhs only. That's the income of earlier years. No? Earlier years, 10, 10, 10, 40 in the 4th year. For that relevant year, what is the income escaping assessment? 10 lakhs. So how much can the assessing officer assess you now? 149, 1 capital A is overriding only 149 subsection 1. It does not override 147, does not override 148, does not override any other section. It only overrides 149, 1 capital A. So the way we understood therefore was there's a lacuna today. There's a lacuna today. So 2 things will happen. Income escaping more than 50 lakhs? Yes. How many years investments have been made? 2 years. Issue notice only for those 2 years. Fine, issue me notice. What is the income escaping assessment for that year only can be taxed, not some other year's income. You can't therefore issue me notice for the earlier year because for the earlier years there's no evidence of an asset being there. Because it's found itself into an asset. You can this is a way of understanding the limitation of 149(1)(a). You may counter me with some arguments. I'm only making a statement. Look at the way the language is flowing. Therefore, look at the technicalities of this issue concerned to say that I can issue notice for these 2 years only. And if at all the assessing officer can tax me, it can't be 40 lakhs. I can very well challenge to say not 40 lakhs, but only 10 lakhs because the income escaping assessment for that year is only 10 lakhs. 147, 148 have not been changed. So therefore, that's an extremely interesting example of looking at 149, 1 capital A very closely. 148B has come into the picture to say that any assessment completed here will be done by the JCIT or the approval of the JCIT or the additional ACIT. Or the approval, if there's a lower officer concerned, then the rank of a JCIT being the JCIT or the Joint Director or the Additional Commissioner of Income Tax, they'll be the persons who will approve. There is an amendment made in terms of the interplay between 149 and 153 capital A. They're trying to make a statement that if you were to issue a notice on the 153 capital A, okay, and that notice is time barred, you will not be allowed to issue a notice under 149. I'll not go into these technicalities. In my opinion, that amendment is not appropriate, is inelegant, is technically also not correct. Because of the paucity of time, I'll not go into that. So the interplay between 153A procedure and 147 procedure has to be seen. We have to understand that the time limit was never there under 153 capital A. Only says 6 years is the maximum time limit up to which you can issue a notice. By what date issue a notice? There's nothing mentioned there. Therefore, the reference to 153A in 149 is incorrect fundamentally. Second, the law itself provides that search prior to 31/3/2021, you can't go under 147, you have to go under 153 capital A. Search happening after 1/4/2021, 153 is not applicable. You have to go under 147. So start making an analysis of the legality of these various sections concerned. You come to a conclusion that the reference in 149 to say that 153A notice 153C notice and their legalities, their time limits, which is 149, that amendment was not required at all. I think this is the brief summary of the procedures, the process relating to 144B and 148, 149, 147 also. Thank you. Huh? Oh, please, yeah. We now have the, please come. Geeta AB, the Central Regional Council member. Come here. The managing committee has said that, no, you can't usurp our time. They have a managing committee meeting. Therefore, they said, wind up your meeting. We'll begin our meeting thereafter. Thank you. No, not covered by explanation. This is a statutory fiction. This is a mandate now to say, hey, you shall wind up your meeting, allow us. Otherwise, they will have to defer the meeting. They have to give us the vote of thanks. Otherwise, we have to give a vote of thanks ourselves and walk out. So they said, no, let us give us a vote of thanks to you. Please walk out 7 o'clock with the deadline for you. And let us thereafter start our meeting concerned. With that, therefore, on behalf of the three of us, thanks to the Bangalore branch. And Prashant, thanks to the Bangalore branch for giving us this opportunity. The opportunity of not talking to you, the opportunity of learning was more enjoyable, more fascinating, more thrilling, and significant value addition to us. Therefore, thanks to the branch concerned for giving this opportunity for us to see that we learn, unlearn, and relearn. Thank you all very much.
We have, I cannot say it's, we have come to an end because what preparation all three sirs and Prashant ji has done for last 10 days, still they may take another 3-4 hours to complete this. That's why we requested sir to conclude this session. We can have another half a day session. We'll definitely planning to conduct another half a day session if sir permits. We'll have a session. Really, yes, sir is kind enough that we'll learning and challenging. It shows his kindness. They'll do each time. This is 19th year they are doing class by class discussion. The time, amount of time they invest in analyzing and sharing, coming and sharing their knowledge is enormous. It shows their kindness. Give them a big round of applause. Branch is ever grateful and thankful to all the seniors, Khincha sir, Chythanya sir, and Ramasubramanian sir, and GS Prashant sir. Thank you, sir. I request chairman to present a gift voucher as a token of gratitude and respect. Seniority. I request chairman to present a bouquet to GS Prashant. I also thank all the members those actively participated virtually and physically. Thank you once and